Hi, everyone. I hope you're all doing very well. And thank you very much for your time today. Today, I wanted to talk about a couple of different things. Last month, we were discussing more the macro picture, sort of how we look at sort of capital allocation. We segment GDP. We look at what's most important. The consumer's most important. Secondly, it's the US government. And that's where the bulk of spending comes in the economy. Consumers fine. The data is very murky because the US government's in not the best situation. Interest expense is extremely high while running deficits at 120% debt to GDP is a very critical situation. But there's a little bit of liquidity left in the RRP. And with the sort of rhetoric from the central bank, the Federal Reserve, it looks like they're trying to drain that RRP before they really act. And so when we take a step back, the macro helps us better understand the micro. Consumers in good shape, okay, that's quite important. So today, what I want to do is talk a little bit more about micro, and we're going to discuss two of the most recent investments that we made, which is getting back involved with Crocs. I'm sure you guys are familiar with that. We bought that last year, and then it had a pretty big run up, and we'll talk about that in a moment. Anyway, we sold it out, had a pretty decent drop of 35%, but the fundamentals are still very strong, and it's a complete outlier in its industry. So we're going to have a look at that. And then Persimmon, where sentiment is completely bombed out in the UK housing market, but we're structurally undersupplied. And the situation that's going on in the UK is very similar to where the United States is. And I think the UK is probably 1 year behind where the US is. And Persimmon is a really interesting company because it's vertically integrated. So it might be kind of scary to get involved in that company today, but no debt, land credits are payable. No debt, £860 million in cash, 14% operating margin because they're vertically integrated. They're at pretty much the average for the rest of the industry that needs to buy everything outside of suppliers. They've got control of their supply chain. Pretty decent margins, £280 million in operating cash flow on a $2.7 billion enterprise value, which is what we paid for it. Very, very, very attractive business. Sure, it's scary, but over the next couple of years, I think it's significantly undervalued. So we're going to talk about both of those. Before we get into that, though, I believe that, and I've said this for a while, I believe we're moving into a stock picker's market. I think the investing in the indexes is going to be a lot harder because of the weightings. And the weightings are really slanted towards companies that have very high multiples. And if the growth slows down a little bit, what might happen? Look at Adyen recently. They're going to increase their headcount. They're going to double their headcount in 2023, and forward guidance for the next quarter earnings are set to be 40% lower. What ultimately happens there? Well, the stock price drops 38% because it was trading at 75 times earnings. There's no room for error there. And so when you invest in a company that has a high multiple, there's not a lot of margin of safety. And so stock picking is going to be really, in my view, a driver of performance over the next decade. So I want to give you an example of that, looking at one specific industry where if you got one company right, you made 120% year to date, and another company that's down 31% on the day in Foot Locker. We'll talk about that as well. And then after that, I want to talk about the noise, right? So we used to do quarterly conference calls with eToro. And unfortunately, I don't think they were too effective because we only had about 30 to 40 minutes once every 3 months. I think this is a much better format. But in those, if you go all the way back to late 2021, we had a slide deck. And the slide deck said the volume of trades in the market after COVID doubled from retail investors. It went from 15% of the volume to 30% of the volume. And what that means is, I guess in a very rudimentary way, you could say there's a lot of inexperienced people in the market. And so volatility would increase if the price doesn't move as people anticipate. What ultimately ends up happening? Well, people buy the top and they sell the bottom. Creates more volatility. In tandem with that, the macro environment doesn't help. Very strong consumer, very weak government, mixed data. And there's a little bit of everything for everyone. People might point to Foot Locker today and say, oh my God, see the consumer is very weak. But Abercrombie & Fitch is up 23, 24% on the day today because the consumer is so strong. And a company that was anticipating no growth this year is actually going to grow 10% on the top line. And so there's a little bit of everything in this economy for everyone. And it's important to get the fundamental micro right and just be patient to sit through that volatility. And that was the view that we made in 2021 is sit through volatility. And if you look at this year to date so far, what's happened? Well, we started off strong, up to 20%. We went from plus 20% down to 6%, up to 30%. And now we're somewhere in around 20.5% so far. A lot of volatility. Just sit through it, know that we have the right assets. And when they get to a point where they've reached sort of like a fair value, we'll just slowly pick them off and reallocate it. So earlier this year, we were selling off Crocs, the last of Crocs we sold off, so $149. Super lucky. We get to buy it back below $100 at the moment. Really attractive opportunity. If you look at like Transocean, we're slowly selling that down. We bought that a couple of years ago. We're slowly selling that down at the moment. It's getting closer to fair value. And so we're reallocating that capital into other opportunities. And so where we are as of right now is, I think, it's a stock picker's market. There's going to be far more volatility. And with that volatility, you're only going to get your conviction to sit through that volatility if you really know what you own. And that's the point of talking about the micro today. Okay. One other thing. I have my light off. I don't know how it looks. Oh, there's lots of comments there. I don't know how it looks for you guys, but I have no light on today. Bilbao had record heat. We had no summer up until a week ago, and today it hit 47 degrees Celsius. So we are getting cooked alive today. So I have all the shutters closed, have all the lights off, have my air conditioning on, but it's a pretty hot day. So I'm sitting in the dark. I don't know how it looks from your end. Okay, let's start off with talking about, let's talk about, first and foremost, that there's lots of noise in the market. We're going to start off with a holding that we own, Lumentum Holdings. Lumentum Holdings is a long-term opportunity that we've invested in. The company has their finger in a number of different pies. AOR, VOR, MOR, mixed reality. That hasn't really even started. The Vision Pro from Apple really got the market excited. And it didn't matter whether Quest was selling 10 million units. It was Apple coming to the market in the Vision Pro, their idea of selling 1 million Vision Pro, that actually changed people's perspective towards these goggles, these sort of mixed reality, AOR, VOR type goggles. Who sells components for that? Well, Lumentum does. As well as that, if you look at AI, what's happening with AI? Data transfer speeds needs to be very high. What does that mean? Well, data centers need to swap out copper for fiber optic. And so fiber is actually growing already, with obviously laying fiber optic for telecoms, but it's growing in data centers as well. So at the margin, fiber optic, with the emergence of AI, is going to drive sales for Lumentum. As well as that, if you look at the transceivers, right, growing 57% year on year, and that market is expected to grow 20 to 25% compounded for the next 5 to 7 years. And so these guys are, they have their finger in many different pies. But the thing about this market is there's not too many players. There's only a couple of players. So they all have the same customers, and there's only a handful of them. So they've got a lot of customers that have big concentration. And what ends up happening when Cena, for argument's sake, increase their inventories 300%? Well, what ends up happening is Cena end up having to work through those raw materials. So they slow down their orders. The end market for Lumentum is still very strong, but the shipments are undershipped relative to that end market demand because inventory is normalizing post-COVID. So in the very near term, the multiple on Lumentum is 15, 16 times. But in a normalized earnings environment, when we get to end market demand, it's trading at about 7 to 8 times. That's super interesting if you've got a bigger picture view. So what we're anticipating is the telecom and datacom market. Datacom's growing pretty quick, largely driven by the emergence of AI or the excitement around AI. And telecom's a little bit slow as we start to normalize that inventory. So revenue is flat as of right now, and it should reaccelerate next year. We've known that for a while. So the reason why I want to bring this up and noise in markets is this is very fairly priced. I want to show you, so I want to explain this here. This was a drop of 8.8% last week. Now, if you don't have your wits about yourself, that's going to scare the daylights out of you, because that happened the day before earnings. And the market made a guess. Anyone that wants to believe that the efficient market hypothesis is real, I've got a bridge to sell you. It's not the efficient market hypothesis is the biggest load of nonsense I've ever come across. But if we look at that drop there, 8.8%, it came on the back of a really weird report from Coherent, which compete with them in the laser space. Now, this is what Coherent had to say. This is their letter to shareholders. They said their backlog ended the quarter with approximately $2.7 billion. That's 100 million up, or 5% sequentially. And orders, a greater than 30% sequential increase in overall order book, with the primary driver of the sequential increase in backlog. So demand was pretty strong for Coherent. They talked about how great their business was. And then they gave the weirdest guidance I think I have ever seen. So let me show you their guidance. They gave their guidance, not included in our full year fiscal 2024 revenue guidance, is several $100 million of additional revenue related to the recent surge in demand for datacom transceivers. So for some reason, they gave a 30% below analyst estimate guidance, despite saying their backlog grew, despite saying orders sequentially up 30%. And then they decided for some reason not to include several $100 million in their guidance, which is very weird to me. Share price dropped 30% for Coherent, and it dropped 8.8% for Lumentum, which you and I can both say that is absolutely bizarre. Now, I can guarantee you there's a lot of people that sold on the lows because they didn't really know what they owned. What ended up happening was the very next day, Lumentum came out and gave their earnings report. Much more clarity in the message. The communication is far better over at Lumentum, and it's very consistent. Hey, listen, it's actually better than what we already guided. We're actually seeing transceivers grow 57%. That market's really, really growing. Datacom is very strong, but telecom side of the business is still a slugfest, and it won't improve until H1 of the next calendar year. So we know we're going to reaccelerate in growth next year. And that's been the messaging for about a year now with Lumentum. Nothing changed. And the share price goes off the lows and it continues to rip higher. Now we're above those sort of sell-off levels. The reason why I want to bring this up is there is so much noise in the market as of right now that price is not a fair reflection of fundamentals. It's a fair reflection of total uncertainty. And that's creating opportunity, but it's also creating a lot of volatility. And I wanted to use Lumentum as an example because it's in our portfolio, but there's tons of examples that you can use where this is actually occurring. So it's really, really important that you get the bottom-up micro and you match it to the top-down macro, to the top-down sort of macro view, in order to have that sort of conviction. And yes, it was a little bit volatile with Lumentum as one of our biggest holders, but what did it do? It gave us an opportunity to actually average in a little bit more. Now, we didn't increase our position a huge amount because it's already 8% of the portfolio, but we had an opportunity anyway to increase our exposure. So noise in the market today is higher than any of my experience in the past. The last couple of years have been very noisy, very volatile, and price doesn't confirm fundamentals. It confirms, at least in the near term, just sentiment. And that, again, that creates opportunities. The second thing I want to talk about is it's a stock picker's market. So you guys may have heard of a little company called Abercrombie & Fitch. Now, Abercrombie & Fitch is not a tech company. It's not an AI play. It's none of these things. They sell clothes. And Abercrombie & Fitch is up 117.5%, and it's up just shy of 23% on the day. Now, across social media, all you can hear about is how the consumer is very weak because on the other side of things, you've got Foot Locker, which is down 30% on the day. So you got two apparel businesses. One is up 23%, one is down 30%, but they're both in apparel. So if you actually have a look at the two businesses, what's the difference? Well, Foot Locker, although it's apparel, it's more like a REIT in the sense where what do? They sell square foot. And instead of collecting a lease payment every single month from whoever's leasing the building, they collect almost like a commission on sales. They sell some Nike shoes, and if they sell it for $100, maybe 10 or 15% of the margin goes to Foot Locker. So it's got cyclical risk, but it's more of a REIT in that they've got prime locations and they're trying to attract brands in order to get that commission. So Foot Locker in and of itself, is that a business model problem? Possibly. Is it a fair reflection of the consumer? I would say absolutely not, because we've seen time and time again where companies like Abercrombie & Fitch, certainly year to date, that are in the consumer space as well, continue to perform very well. Abercrombie & Fitch, from a bottom-up perspective, what happened coming into this year, they needed to shed a bit of inventory. The changes to working capital meant that they'd be able to raise $100 million, and that's exactly what happened. $100 million of free cash flow was unlocked through net working capital. So this is a scenario where, fundamentally speaking, even if growth didn't increase on the top line, free cash flow would increase as they shed that inventory, right? So that's an interesting play, and that's something that a lot of people miss when they're getting involved in sort of retail stocks. The second thing is, this is a company that was slated not to grow, and they actually grew 10% year on year. So you've got a bipolar market, and it really comes down to the fundamentals from the bottom-up perspective moving forward. It's not a case of, hey, this company looks like it's going to go higher, therefore the whole industry. It used to be the case in a low interest rate environment, in a very passive environment that we've seen over the past maybe 10, 20 years, where passive flows were very dominant. We've seen a scenario where if one company was doing well with varying degrees of percent gains or loss, you would see the whole sector increase or decrease. That's not really happening anymore. It's a very multipolar world. And it's also split between different classes. So we're talking about savings and assets and all that sort of stuff in the macro picture. But what we didn't talk about as well is 90% of the bottom 20% in the United States, as an example, 90% of their income is on non-discretionary items like shelter and food. There's not a lot of room for inflation. So when inflation increases to 9.1%, what happens to that class? They get crushed. And if you look at a lot of sort of not entry level, that's the wrong word, but if you look at a lot of businesses that are catering towards more value side of things, they're not doing very well at the moment. And so there's a number of different variables where I think this market is really ripe for a stock pickers market over time. So a lot of volatility. I think it's a stock pickers market. And I think that the last 10, 15 years, there's going to be a lot of bad lessons that were learned that I don't think are going to work moving forward. And there's just a couple of examples of what you're seeing at the moment. And sentiment is a hell of a drug. It's a hell of a drug when you consider, no matter what you see at the moment, the consumer is tapped out. Why is the consumer tapped out? Well, because Foot Locker's down 30%. Abercrombie & Fitch is up 23%. If you go back a year ago, it was advertising businesses are destroyed. Why? Well, Snapchat missed earnings. Snapchat's never been profitable. And so sentiment is a hell of a drug, and there's a little bit of everything for everyone. So you got to be very careful about what it is that you listen to. Okay. I'm going to get straight into some of our analysis. I'm going to be talking about CVS a little bit later. The way our portfolio is broken down is we have our AI plays. I call them AI plays. They're not really AI plays. AI is a buzzword. But I do think it's going to make a big difference in the future with decision making. And there's going to be two different winners. There's going to be those winners that are infrastructure plays. So you can go out and buy a very overvalued NVIDIA, or you can buy something like Lumentum, which will get those tailwinds over the next decade as well. But I'm not paying a couple of 100 times earnings. I'm paying 7-8 times in a normalized market, right? So you have those sort of infrastructure plays. And then you have data plays, right? So I read a great post this morning by Gavin Barker, who's a fund manager in the tech space. And he was talking about who the AI winners are going to be. It's not going to be sort of the ones that you think are obvious. It's going to be the ones that have the data. Who have tons of data? E-commerce businesses, fintech businesses. They're going to be the winners, where they'll be able to hollow out their expenses on the SG&A side and expand their margins. So it's going to be very interesting there. We're looking at companies like Veradigm, right? Veradigm have access to 130 million electronic public health records. As of right now, they're using that data and they're selling that raw data for research purposes, but there's plenty of opportunities for them to actually use that data to create new products. And so when you have a look at these different types of businesses, I think the ones that have access to high quality data and the ones that are infrastructure plays are not obvious today, but as we get through the decade, they may never become obvious, but what will become obvious is either margins expanding, top lines growing at a faster pace and becoming far more profitable. And eventually the multiple and the price of these different securities will look after itself. Okay, let's get, and so that's one part of the portfolio, excuse me. Then we have real estate. Real estate's super interesting. Everyone's looking for a house price crash, and it hasn't come, and it's probably not going to come because we're in complete lockdown in the real estate market. Fixed rate mortgages, housing supply is just not there, and it continues to get tighter and tighter with mortgage rates in the United States over 7% and in the United Kingdom over 6%. It continues to get tighter and tighter. We bought into Persimmon, which we're going to look at now in a moment. Persimmon cut their supply, the volume, from 15,000 units down to 9. So across the board, and they're in a much better position to cut that supply. Across the board, home builders in the UK are cutting supply when we're short about 1 million homes, right? So it's a really interesting market where the marginal supply of homes coming online will set the price. And demand it's probably fairly balanced when you consider that the supply of homes available is very low. So we have real estate. Vonovia as an example is our biggest position. Vonovia is another one where A lot of people are very negative on German real estate, but this has been working for us. And the reason why it's been working is because debt maturities are fine. The level of leverage is fine. Interest expense is not going to, even when it re-rates higher, is not going to be a big issue. And the reason why it's not going to be a big issue is because they're retiring debt at the moment. The cyclical side of the business, the construction side, they're unwinding. And it's just a rental business. We're the biggest landlord in Germany. I think it's the biggest landlord in Europe. And we paid 60% below market value for this. So if you were to sell all the properties that Vonovia own at market rates today, factoring in a 10% decline in house prices, the share price would be up 70, 80% from here. And that's what's really interesting about it. These guys are spitting out very stable cash flow for shareholders. So it's kind of an interesting one where, again, the sentiment's very negative. Oh my God, inflation, interest rates, occupancy rate went from 2.4% down to 2.2%. And we're seeing rents increase 3.4% year on year. Rents are going up, occupancy is going down, the fundamentals are improving. Share price got crushed on sentiment. Very inefficient market. Creates an opportunity. Okay, let's start off with Crocs. Crocs obviously is it's a more discretionary type company, but it's a complete outlier. And we invested in this last year, and a lot of people were very surprised as to why we'd invest in this, because it's a fad. And fads usually last one season. However, Crocs has compounded its net income at 35% per year for the last decade. So this is not a one season, one trick pony. These guys have been very consistent for a long period of time. And they're adopting the US model of digital exposure and growth there over in Asia. And it's growing at a faster pace than what they forecast. They forecasted 25% growth in the Asia business, which is 15% of their overall revenue. It's actually growing at 30% so far. It's growing at a faster pace, not a fad. But this is what's really interesting about it. If you look at the 5-year average return on invested capital, they have the highest in the market. There's Nike over there, much lower, below 30%. These guys are about 35%. Highest rates of return on a 5-year average basis. If we look at the multiple on a 1-year forward basis, it's one of the cheapest. So it's a complete outlier relative to the basket. This here should go from the bottom left to the top right. Low rates of return, low multiple. High rates of return, high multiple. Crocs is high rates of return, low multiple. Anything in the top left here is a total outlier, complete outlier. And that's a good thing. It's a good thing that it's cheap. It's a good thing that it's got high rates of return. And the reason being is it allowed the company to repay $850 million worth of debt. Why? Because high rates of return mean the required capital for working capital, we'll look into it in a moment, to grow. The marginal dollars required for working capital to grow is a lot lower, meaning you've got much more available cash for debt reduction. At the same time, you can do share buybacks, dividends if you want, and they bought back $50 million worth of stock as well. $900 million in shareholder distributions, you can call it, since they bought Hey Dude, and it's still dirt cheap. So because the multiple is very low, you've got $1 billion in authorized buybacks on, is it a $6 billion business? Market cap wise, 18-20% of the float could be bought back. On top of that, the business is still growing, 10-15% compounded on the top line. So Crocs is a complete outlier in its market. You got to understand the business model here to really understand the genius behind this company. And this is why I really like it. And this is why, in the face of negative sentiment, oh my God, Crocs are the ugliest shoes, you just know who's doing the work and who isn't. Crocs have been killing it for actually quite a while. It didn't just wake up yesterday and start performing. It's over the past 5 years. You've got Adidas. Like, we go up here and we have a look at Adidas. Adidas is the most expensive and one of the lowest rates of return. The total return for Adidas over the past 5 years has been negative 10%. The total return for Crocs has been 500%, right? Significant outperformance, better quality business. But everybody associates Adidas with a higher quality brand, but that's not the reality from an investment perspective. So there's a couple of different things you need to understand. So the business model, Andrew Rees is the CEO, joined the company in 2014. Company was growing fast, but it was a mess, right? Back-end stuff all over the place. 2 phases. Phase 1, reduce SG&A, close low return on invested capital stores. Second phase, focus on the consumer, right? How would they focus on the consumer? Scale back the number of SKUs. They had hundreds of SKUs. They scaled it back to the original clog, and they just had 10 different colors. The reason they were able to do it is because they made an acquisition of Jibbitz. Jibbitz is a customizer of Crocs. They clip into the Croc. And there's like over 10,000 different types of styles of Jibbitz. So what that allowed them to do is cut their manufacturing costs because they're only making 10 different shoes. But the reality is with personalization, there's an infinite number of actual shoes that Crocs sell because you buy the customization with Jibbitz, and each customization, when you got like 10,000 different Jibbitz, each Croc can be different. So you have personalization. People can express themselves in different ways. And that led to, that took a couple of years. It finished in 2018 when they turned the business around. And then since 2018, they've really been focusing on the consumer. So as well as that, they have a test and plan. The competitive advantages, before I talk about test and plan, the competitive advantages is cross-light pattern. The material that they use is like a foam base. It's easy to mold, and it's dirt cheap and common as dirt. The skill required to make these shoes, it's entry level. They don't need high skill labor. So let's say labor gets very expensive in one area, they'll shut down the factory and move to another area. If materials are locally sourced and you've got cheap labor with a high demand market, they'll just move their factory there. What happened last year? Cost didn't increase for that reason. Yes, capital expenditure went up. They're building out distribution centers and whatnot. But cost didn't increase related to operating expenses. So what did they do? They passed on average selling price 8% hike with no inflation. Margins expanded. Great business. Super, super attractive. So when you look at the margins, not only as an outlier on rates of return and valuation, you have like the 5-year gross margin. They've got the highest gross margins. And the 5-year operating margin, on average, they've got the highest operating margin. Cheapest business, one of the cheapest business, highest rates of return, highest margins across the board. There's Nike. Why does Nike deserve a much higher multiple? Just because it's better known? Crocs is spitting out cash. As an investment perspective, what would I prefer to own? 100% Crocs. Growth, a little bit of a scare, right? So if you have a look at growth, Asia is growing 30% compounded. How is it growing? Well, they have a very interesting sort of strategy where they partner up with different celebrities and different sort of influencers, create custom Crocs, and then they push that onto a test market. So because it's so cheap to produce it, because they have a sort of billion different ways in which they can design a Croc, they can do test and plan, where they can do 1,000 Crocs, push it onto a market, see what the success rate is before launching it. R&D expenses are very low, and that's why the rates of return are very high. It doesn't cost anything. Crosslight's dirt cheap. Making Crocs are dirt cheap. It's all margin. As you can see here, it's all margin. 55% gross. No one else in the market has that margin. And close to 20% operating margins on average. Operating margins as of right now are 26.5%. But the 5-year average is about 19. It's far better as of right now. Growth is pretty impressive, 30% compounded in Asia, and how they're excelling that is partnering up with, so China is a very interesting market for them. China is very slow for many different brands, but it's growing pretty fast for Crocs. They've personalized a different Croc for a couple of celebrities, and they're selling like wildfire. It's 100% above expectations, and that's why the compounded growth rates for Asia are 30% and not 25%. When we have a look at their guidance, it's $1 billion for Hey Dude. They've already really achieved that on a trailing 12-month basis, and it's $5 billion by 2026 for Crocs. This is really interesting. Market's concerns on the latest quarter. The reason why we had a big drop in Crocs, if you have a look at Crocs here, the reason why we had this big drop on the latest quarter and this big drop over here on the prior quarter, inventory increased and there was concerns over demand, and therefore the share price dropped lower. It gave us another opportunity. So when we're looking at Crocs, what's really interesting is let's segment it. Crocs, Hey Dude are the two brands, and the distribution channels are direct to consumer, wholesale for each. Look at the growth rate. I color coded this here. This is revenue. Look at the growth rate for Crocs. And I started in 2019 to show that this is not a COVID phenomenon. This has been going on for a long time. This growth has been around for a long time. 6-7 years, they've been growing like a weed. Crocs is on fire. Year on year, relative to the June quarter, 25% growth direct to consumer, 3.8% wholesale. It's not fantastic, but it's still growing. Here's where the problem was. They bought this Hey Dude brand. It done $500 million in revenue, $2.5 billion they paid for it. 5 times revenue for an apparel business is crazy. but it was high growth. And you can see anyway that the revenues have doubled since they bought it. It's close to $1 billion as of right now. But look at this, right? So the direct consumer is still up almost 30%. The problem is wholesale, and that's been very mixed. And the reason why it's very mixed is many of the wholesale suppliers for Hey Dude there's not a lot of historical data. So heading into the end of the year, they don't really know how much inventory they need because there's not a lot of history with Hey Dude. They've only just pushed it into a lot of US wholesale channels. So there's not a lot of history there. We don't know what the market appetite is yet. So they're a little bit conservative as of right now. So it was down 8.4% year on year. We could end the year and that might be too low. We don't know yet. So they're just being a little bit more conservative. When you take a step back, Crocs, which is the majority of the business, still 60% of the business, it's growing like a weed. That's to be determined, but the quality of the brand at almost 30% is pretty attractive, right? It's really attractive. So direct to consumer is still fine, and that's a higher margin than wholesale. So we're pretty much in good footing. But look what the market done. The market went from $150 down to $100. What am I going to do? Well, I sold it, but I get to buy it at a 30-35% discount for a fabulous business, a really fabulous business. And so we added it back. We just finished adding it just before the call. I added the last little bit, bringing it up to about 6% holding. So it's a pretty decent size, but you can see the quality of the business. Now, what happens to the price in the near term? I have no idea. But over time, what's my expectation? I think it can double. When you look at the financials, the debt itself is perfectly fine, long maturities, and they have one covenant on the revolving credit. Don't get leverage above 4 times. Has to be below 4 times. They're at 1.8 based on next year's numbers. How did that happen? Debt came down $850 million. $50 million was bought back in shares. That's $900 million. And at the same time, net income's gone up 50% since they acquired Hey Dude, right? So the leverage in the business just collapsed. There's no real leverage there anymore. So when you're looking at the balance sheet, the debt is SOFR plus 3% on the term loan, which the CFO just announced that they cut 50 basis points for no extra real, for absolutely no changes to the deal, just because they got down to deeper investment grade on their debt, on their leverage. The banks or the creditor was willing to bring down SOFR plus 3.5 down to SOFR plus 3%. Does that make a big difference? Yeah, I mean, it's $6 million in interest expense saved for doing absolutely nothing. When we look at their capital allocation for a moment, I just want you guys to look at the rates. 8.3% on the term loan B facility. That's factoring in SOFR at about 5.3%. That's the overnight rate. And revolving credit is plus 2%, right? So that's the revolver credit, 2.025%. So 7.3% there. Just keep an eye on both. And that revolving credit's really a securitization. It's really a receivable securitization facility. It's not like, it's really just to bridge the gap between receivables and payables. 7.3% though. So it is pretty high interest on an annualized basis. Company sitting on $166 million cash, $700 million in free cash flow on the top line. And they could unlock about $175 million in working capital. How did I come to that conclusion? Average working capital has been roughly $290 million. So if you factor in that, obviously prior to 2022, they didn't have Hey Dude. But if you also factor in that Hey Dude's only 50%, 40% of the business, if we increase working capital requirements, there's about $175 million that they can shed, cutting back inventory. And that's what they're doing at the moment. So you can see free cash flow increase. Remember at the beginning, we're talking about free cash flows possibly increasing from Abercrombie & Fitch over the past year, which played out. Even if revenue didn't grow, where does that come from? Working capital, right? So this is the working capital at the moment. We could shed it by about $175 million. So free cash flows can grow at a faster pace than the top line as they shed that working capital. Working days is still pretty good. What that means is they need about 77 days of capital for that capital to turn over per 77 days is the cycle. And then we have working capital requirements. So for every $1 of growth, this is a company that's expecting to grow in Asia at 25% per year. How much is that going to cost in working capital? We're going to have payables, receivables, and inventory associated with that growth. How much is it going to cost us? For every marginal dollar, it's going to cost us about 16 cents, 15.8 cents for every one marginal dollar of growth. And that's going to be tied up for 77 days. That can come down. I think it can come down back to around the 2019 levels of 14, because this isn't really the same as working capital. It's just more about efficiencies. So there is still room for improvement, and free cash flows can continue to grow at a faster pace. So when we're looking at the business, it's a phenomenal business. And as of right now, the catalyst would be free cash flows growing at a faster pace, changes in working capital, stable 10 to 15% on the top line, and the company starts buying back hand over fist and continuing to reduce debt. Capital allocation strategy, buy back stock. They have $1 billion, $1.05 billion in authorized buybacks. And I think the market cap is somewhere around, I think it's somewhere around 6 billion. So you can buy back about 18-20% of the float, depending on the fluctuations in price. The $47 million, 47 million shares in the treasury, and on average they paid $35 for those. So share price is currently at $99. They've added a lot of shareholder value through share buybacks. It's been part of the growth story. It's part of the outperformance. Part of the bottom line growing at a faster pace is sucking up shares, and they're expecting to continue doing that. So that's going to be a big driver of the share price as well. Who's the natural buyer? The company themselves. They produce a lot of cash. Debt reduction, and I'd argue that debt reduction should remain the primary focus. And the reason being is you can buy back debt today and guarantee an 8.3% yield on it. Why? Well, if you retire debt that was yielding 8.3% in interest, that interest now becomes part of your net income. It's guaranteed 8.3%. Why not get that down a little bit? So it's lower risk. You'd still get a guaranteed return of 8.3%, would prefer more debt reduction. They're going to prioritize share buybacks, continue to reduce debt, and then there might be some M&A. They've done 2 major M&A. Well, I won't say major. Jibbitz was a $10 million acquisition, but it contributes $100 million in revenue today with high margins, right? 60% operating margins. Hey Dude it's still, it still has to prove itself, but it's looking like it's going to be a good acquisition. Revenues have doubled in about 18 to 24 months. Still, the jury's out there, but on both of those acquisitions, it looks like it's going to be strong shareholder returns. Across the board here, debt reduction, buybacks, and M&A, capital allocation strategy means that we should get paid handsomely for holding the stock over the next couple of years. So it's quite interesting. If we go back and we look at the share price, this share price down here, believe it or not, we are in about 10% away from this valuation. And the reason why we're 10% away from this valuation is if you go back here, the price to earnings ratio was 4.6. And that might seem low, but they had just taken out $2 billion in debt. So the enterprise value of the business was a lot higher. It was much higher because they had a lot more debt here, and the net income was lower. So although the price to earnings was very low, you had a business that was a little bit more expensive factoring in the enterprise value. What's super interesting is despite the equity valuation being in excess of 100% above there, we're pretty close to that valuation. Why? They repaid $850 million worth of debt. Again, this is an $8 billion enterprise value business. So they paid 850. That's 10% of its entire valuation. They paid that back in debt, $50 million in buyback on the latest quarter, $900 million. At the same time, net income doubled. So net income has gone up because of the fantastic acquisition, the growth of that acquisition, and Crocs is just a fabulous brand that on the latest quarter, direct to consumer is still growing 25% year on year. Fabulous. So you have a situation where when you map that out into a chart, this is what it looks like. 9.6 right on the lows last year, and we're at 10.73 as of our average price. It's pretty damn close. And the risk is significantly lower. And now we're going to see not debt reduction, but buybacks. So there's going to be a natural buyer to stock. So this kind of cash flow model would suggest $184, $185 per share. But you also have to factor in that the outstanding shares could be reduced materially. And that would mean that intrinsic value would be way higher. Basically, what I'm trying to say is when we look at Crocs, this is going back to the macro and then tying it into the micro. Consumer strong, plenty of cash. I know people are talking about net cash going negative, but they're not talking about the massive increase in money market funds to get yield on your savings. Consumers are still very rich. They're just not spending it or it's not as visible as it was previously. Consumers are in great shape. They're spending a lot of money. And if you have the right brand, company, etc., you can make a lot of money in this space. Crocs are literally running on all cylinders. It's a really, really, really fabulous business. And that's why I got back into it, because the valuation, despite the share price being a lot higher, the valuation is pretty close to what we've seen back in May and June. So the reason why I wanted to talk about that is because now that you understand why it is that we bought it, if the share price drops 20% from here, what am I going to do? Well, I'm going to buy more. Why am I going to buy more? Go back to the example at the very beginning. There's a lot of noise in markets. Look at Lumentum. The day before Lumentum's earnings, Coherent comes out. And it's just a bizarre earnings report to begin with. But the share price was down 8.8% on Coherent's 30% drop. And then earnings come out and the share price recovers, and then we start to see a big, massive increase in the share price. I say massive increase. I mean, I don't think it's all, yeah, it is a pretty decent. It's up by 15% in about a couple of days. Anyway, so there's a lot of noise. So I often get feedback that comes in. It's like, why don't you sell this position? Why don't you buy the top? Or why don't you sell the top and buy the lows? With this amount of volatility and uncertainty, certainly in the short term, I wouldn't even begin to play those games. And so although that volatility will come, it'll also go, and it can be an opportunity. So we got another opportunity to get involved in Crocs. And that's, to me, that's super exciting, because now I'm invested in a company that's really high end at a very good price because of that market inefficiency, right? And I think we're in a position now to possibly double our money on this position. And this is coming on the back of Capri Holdings, which was really, really bizarrely undervalued. And fortunately, a week after we bought into that, similar kind of scenario, very different businesses, but similar kind of scenario, bizarrely cheap, with great opportunity to see the price push higher a week after it gets bought out, or there's an offer from Tapestry. It's up 55%, something like that. So these businesses, I think, are, if you have the right understanding of how to analyze them, looking at working capital, balance sheet, understanding debt maturities, and then trying to figure out their business model and the customer to get a glimpse of growth and margins. If you have that edge, and then obviously the capital allocation strategy feeds into it, I think you can make a lot of money in the sector. So Crocs, I know a lot of people look at it and say, ugly shoe. I've got 8 pairs in my house, believe it or not. They sell like hotcakes. The demand is still very hot, even on the latest quarter for Crocs itself, which is the biggest component, 25% for direct-to-consumer, and 29% for Hey Dudes, direct-to-consumer. So the demand is still very much there, but there's a near-term uncertainty with rising inventories, with high capital expenditure for the Las Vegas distribution center, at the same time, concerns over that wholesale, which is really only, as of right now, a small part of their business. It's about $120 million of about a $3.8 billion business in terms of revenue. It's a very small part of it. But I guess the market was concerned about its valuation. So Crocs was just added in the last couple of weeks. In the last maybe week. We finished adding it today. And the other one that we bought, which is, again, another one that might be a little bit more contrarian relative to what people are used to, but home building within the United Kingdom, looking at Persimmon more specifically. Persimmon is a PSNL. Persimmon more specifically is a super, super, super interesting company. So Persimmon is a home builder. And let's talk about all of the bad things, and then we'll address it in a moment. So yes, inflation's high. Yes, interest rates are higher. Yes, there is a number of fixed rate mortgages that are going to re-rate higher once they roll, because they're only 2 to 5 years fixed rate in the United Kingdom. Yes, all those things are bad. Sure, they're all bad. But it's already fairly reflected in the price, certainly as far as I'm concerned. And I want to go over all of that, because sentiment, when a company goes from absolutely terrible sentiment to just bad, that's where you make most of the money. And right now, the sentiment in UK housing is about as bad as it's ever going to get. So let's look at Persimmon and try and figure out where the risks are. So if we have a look at US home builders, I don't think this is very dissimilar to what's happening in the US. You have a scenario where we have inverted CPI. So CPI is in orange. A couple of months after this bottomed out and pushed higher, home builders started pushing higher. It's not a surprise to understand why that occurs. Input cost materials, the price went down, margins expanded, and it gave more support to home builders. That's part of the question. The other question is, what was the volume and how much profit did these companies make? Obviously, in hindsight, we can say they've done very well. 64% off the lows for the SPDR home builder ETF. I was invested in a company called MI Homes relative to the price that we paid for it. And here's another example of, multipolar market. We paid $47.58 a share for MI Homes. It immediately dropped 25%. It's now about 95% above what we paid for it. Now, I'm not holding it today. I think we made 22% on average for the position, but I sold it out. And the reason why I sold it out was the difference between the US and the UK. Where I have more confidence today is obviously the experience going along with MI Homes, but as well as that, with MI Homes, we didn't know what the volume decline was likely to be. We were kind of guessing. We knew home prices would stay high because there's a shortage of homes and there's a lot of fixed rate mortgages. So the marginal buyer and the marginal supply were at equilibrium. Home prices stay high. Home builders at the margin can continue selling houses at very high prices with very wide margins. Yes, revenue is going to go down, but profitability would still be elevated. Now, if revenue went down, if the volume went down 50, 80%, well, then maybe it might be not that much of a good value. And that was where my concern was. Mortgage rates hit 7%. We didn't really know how low volumes would go. And all we've been seeing is volumes have been exceeding expectations in the United States. Toll Brothers just came out recently. Pretty good guidance. D.R. Horton, quarter in, quarter out, good guidance. Volumes were actually much better than expected, which is what led to that fantastic performance. The uncertainty there was what? The uncertainty was, hey, how far are these volumes going to fall? Sure, we're paying a good price, but that's on maybe rosy guidance. If that volume comes down lower, maybe it's not as cheap as we thought it was. Unfortunately, it ran off. It is what it is. Persimmon's in a similar situation, I think, I think the UK housing market's in a similar situation. So let's have a look at this. Housing supply in the United Kingdom is undersupplied. According to the government, there's a shortfall of 1 million homes. And there was guidance. Michael Gove gave a plan to produce 300,000 homes per year back in 2020 and get back to balance by adding 1 million homes. We're 1 million short by adding 1 million homes by mid-decade. It's 2023. Here's where we are, 205,000 for 2022. This year is going to be significantly below. How exactly are we 1 million homes short? Well, if we go back to prior to the global financial crisis, what ends up happening? We're at market supply. What we need, the replacement value. There was a lot of speculation, obviously driving house prices higher. So the debt markets crushed the housing markets, and the supply, all these home builders got burnt. Supply goes from 215,000 down to a low of 133,000 homes. All of this period of depressed supply needs to be made up. We don't have enough homes. That's why home prices are still very high. People are complaining about home prices. It's not going to crash. There's not enough homes for sale. As of right now, demand is 3% above 2019 levels. Home prices are 19% higher than 2019 levels, and sales are 15% below. Think about that. That's a direct result in the United Kingdom. That's a direct result of a housing shortage. So there's tight supply. Let's get into it. Why Persimmon? Industry average enterprise value to EBITDA is 6.78 times. Persimmon's slightly above there. Now you can pay a little bit more, and these are depressed valuations across the board, but you can pay a little bit more if the company is superior, higher rates of return, higher margins, etc. So if you look across the board, there are some that are cheap, but sometimes they might be cheap for a reason. So we go a little bit deeper. So we look at operating margins, highest operating margin. Who's blue here? Who's dark blue? It's Persimmon. Average 5-year operating margin, 25.5. Highest margins in the business. We'll explain why in a moment. Rates of return, average 17.4%. Persimmon, 23.89%. Return on invested capital on average over the past 10 years. Right? So high rates of return, high margins, slightly more expensive. Much better quality business. We'd rather get involved there. Competitive advantages, vertically integrated. The company is vertically integrated in that, let me go down a little bit further here. They're vertically integrated in that they've got brick and tile factories. Space4 is manufacturing their timber frames and insulation, and the roof cassettes are in-house. So they're able to build everything in-house. As well as that, they've got a very attractive fiber nest business, where when they're building these communities, they put the fiber into the ground. So the cost of actually putting the fiber in the ground is way lower than digging up the road, stopping traffic, diverting traffic, putting in the fiber, fixing the road, and then reopening the road. These guys are building the community from the ground up. And because they're building it from the ground up, they automatically have every house plugged into FiberNest. What does that mean? It means 330 communities have access to broadband. 30,000 homes are signed up to this. So at the margin, it's a very attractive business. It doesn't cost them much to grow relative to their peers, and it adds fantastic cash flows to the business, consistent on a monthly basis. So vertical integration means that they're not paying a margin to the brick factory. They're not paying a margin to the timber factory, insulation factory, whatever it is. They're not paying any margins there. They're doing it all in-house. And that's that's really why when you're looking at the margins, they're a standout player relative to their peers. So when we're looking across the board, why is they got the best margins? Because they have the best business model, right? And what does that mean? It means that when you do have problems with inflation, the margin will go down, but it'll go down somewhere to the average. The average is falling somewhere around 15%, in and around there. Right now, we're at trough margins for the business at 14%. That's competing with the rest of the industry's average, 5-year average, 10-year average. That's where Persimmon is in the worst possible market environment. Some of those other companies will go bankrupt. Crest Nicholson just came out recently and said that their profits dropped 30% due to inflation. They're not vertically integrated. Inflation is, the supply chain is brittle. The cost of that supply is increasing. It's not very good. It's not very good for Crest Nicholson. It's great for Persimmon because it's vertically integrated and they can control their costs. Super interesting business. Average selling price for the company relative to the UK average home price, $248,000 for 2022, a 13% discount relative to the average. So not only are they the most profitable, they're also one of the cheapest producers of homes. Pretty interesting in the latest market environment. There's a couple of things that were wrong with this. I'm going to go through this a little bit quicker because there's a ton of questions and I'm already 50 minutes in. So there's a couple of things. There was a lot of problems with management, super greedy management. Previous CEO gave himself £100 million. It's pretty bizarre. You got a $2.7 billion enterprise value business. Previous CEO believes that he was worth £100 million. Not only did he think he was worth £100 million, but he thought he was the most valuable CEO at a point where Persimmon ranked bottom for customer satisfaction. What a greedy pig, eh? So this guy, the previous CEO, had cut a lot of corners, problems with quality. He got booted anyway. The chairman of the board, this guy's very generous. If he does have a company, I hope one day to be an executive for him. He authorized £850 million for the top executives in the company. $2.7 billion enterprise value today. Might have been different in 2018. Prices were higher. But, I mean, there's a level of greed there that I haven't seen before. So these guys, if you're ever investing in a company, run like hell if you ever come across Jeff Fairburn or Nicholas Wrigley. Don't know them, don't know anything about them. But I look at the shenanigans and I'm like, wow, that's a company to avoid. National Express previous CEO Dean Finch came on board. Primary focus was really to turn the image of the company around. 2021, they announced they doubled the quality inspectors, and now at the very top of every single presentation is what? Quality satisfaction reports. And it's improved significantly. It's the main focus of the company. So that's, I guess, part of the reason that might be holding the company back, but that's been addressed. If it is dragging the multiple lower, well, that's created an opportunity because over the next couple of years, it'll be very clear that these guys are a good operator. The other thing is concerns related to rolling fixed rate mortgages. So let's just have a look at the numbers. There's this theory that all of these fixed rate mortgages are going to re-rate higher and then all this supply is going to hit the market. There's one thing that I want to say first and foremost. A house is not an investment to 99.9999% of people. It's a home. It's shelter. Nobody looks at their house and says, somebody will buy my house for $500,000. I'm going to sell it today, live in the park in a sleeping bag for a couple of years and wait for home prices to come down. Nobody does that. If you're to sell a house for $500,000, you're going to have to buy it in the same market. So home is not an investment. And that's what a lot of people miss. Let's have a look at the numbers though. 24.8 million homes in the UK, 8.5 million mortgages outstanding. That's as of last year. The numbers don't really add up massively here. They're slightly off, but it'll give you an idea of where we are. 6.88 million variable rate mortgages, and the rest is semi-fixed. UK don't have 30-year fixed mortgages. I got a 30-year fixed mortgage of 1.2% per year for 30 years. In the UK, you have semi-fixed, 2-year fixed, 5-year fixed. They have different rates. You don't really have that in, like certainly on the continent in Europe, you can get longer duration mortgages. You don't have that in the UK. So in the UK, it's not common. The total mortgage debt's 1.68 trillion. And that means that there's 31% of equity in the homes of all those homes that have been bought. So it's 69% loan to value. It's quite a bit of equity, believe it or not. There is quite a bit of equity there. So in H1, there were 700,000 mortgages that were fixed, that expired, and they're going to re-rate higher. They did re-rate higher in H1. So in July, after these mortgages re-rated higher, Rightmove, who do the housing report, they said that the buyer demand remains resilient at 3% above 2019 levels. More normal market levels, buoyed by a shortage of quality properties for sale and ongoing housing needs, shortage of supply. So demand was 3% above, despite 700,000 people having to pay a higher mortgage rate, right? So we're already seeing this happen. We've been seeing it happen now for about 2 years. So there's another, I think, 2 million mortgages into the end of 2024 that will re-rate higher over the next 18 months. We've already got a snippet of that sort of rollover, and it's not increasing the supply. Sales today, 15% below 2019 levels. Prices are 19% above. Shortage supply is keeping those home rates much higher. So when we're looking at it, it's structurally undersupplied. That's the problem in the United Kingdom. And home prices are unlikely to crash, despite what a lot of people think. So there's two things to consider. Mortgage rates are already rolling over. The average is 6.3%, a blended rate, 6.13%. It's rolling over with inflation. So that's going to continue being a tailwind. Second thing is the latest wage data in the UK was the highest since, I think, 2002 or 2004, but it was 7.8% on a 3-month average. On a 3-month average, wages were 7.8% higher versus the year prior. It's the highest in decades. So affordability is improving because mortgage rates are coming down and wages are catching up. So UK households, it's in better shape than what a lot of people think. Lower asking prices combined with increasing average earnings. This is in the latest August report. And the apparent downtrend in mortgage rates are tentative steps towards improved buyer availability, although average prices are still £59,000, 19% higher than what they were pre-pandemic. So when you look at the dynamics of the housing market, it's not what you're hearing on social media or from your neighbor or your buddy down at the bar. It's very different. Broadly speaking, it's healthier than what's reflected, in my view, in the share prices of these companies. So I'm looking at companies like Persimmon. They'll do 9,000 homes, average selling price £256,500, 14% operating margin, operating cash flow £280 million, $23 million or so in capital expenditures. It's close to 10% free cash flow yield on its enterprise value. Company's guidance, they gave a bunch of different guidance last year. We are at the bearish scenario, which was 8,500 volume. They're actually going to do 9,000 volume. They said that the average selling price would be somewhere around £250,000. They're going to do £256,500, slightly better on both counts. Operating margin has been confirmed at 14%. So slightly better than the bear count. The bear count would leave operating cash flow £297 million. $2.7 billion business, 10% free cash flow yield at the trough of the market. Why? Supply is down 40%, right? Supply last year was 15,000 across the board. There's other home builders that are cutting supply more than Persimmon because they don't have that luxury of wide margins. Persimmon are cutting it by 40%. Marginal supply is collapsing this year because mortgage rates are going up. Massively collapsing. But if they can sell 9,000 houses at £256,500 on average, which is 40% below, with a 14% operating margin, which is 13% below where it was last year. Last year, they had 27% operating margins. That there in and of itself is absolutely terrifying. A collapse in margins and almost a halving of the volume. It's terrifying, but we didn't pay those prices. We didn't pay very high prices. So therefore, what happens? We should be able to get decent returns from here. Now, I don't know what happens to the share price in the near term, but if I hold it over the 1 to 3 year time horizon that we have, we should make a lot of money. And so let's just skip all this. This is just going over a lot of this stuff. We're expecting back to 15,000 by 2026. Analysts are anticipating pretty decent volume growth over the next couple of years, back to 15,000. If you assume that margins expand with lower inflation and a couple of points on home price index with lower mortgages and higher demand, probably back up to 20% operating margins, and you're back up around 15,000 homes, you're looking at $1 billion in operating cash flow on a $2.7 billion business. It's like a 40% operating or a 40% free cash flow yield. Capital expenditure is only $23 million, 23 million pounds. Super interesting. Anyway, working capital. Anyway, just on the valuations, 18.59 pounds is the fair value, but if you have to factor in the 861 million pounds in cash and no debt. If they were to take that 861 million, buy back all of their stock that they can with that at today's valuation, what would the business be worth? Let's look at the enterprise value. That would assume that it's 115% on the upside. So it really depends on what they can do to generate returns on that. But there's anywhere from 65 to 100% on the upside over the next couple of years. And I find that as very attractive returns that could exceed expectations for the reasons I mentioned a moment ago. Falling inflation, falling mortgage rates, wage growth, higher affordability, home price index starts to exceed on the upside, volumes recover, margins expand, profitability gets back up to maybe £1 billion in operating cash flow. This would all be wrong because the unlevered free cash flow into 2026, according to analysts, is assuming £567 million. Could be way off by a factor of 2. So that's per Simon. Now, when things go from terrible to bad, that's where you make a lot of money. And right now it's terrible. 40% lower volumes, 13% cut in operating cash flow, or in the operating cash flow margin. That's a terrible, terrible environment. If that's marginally better into the end of the year, this is really mispriced. Sentiment changes, and then you're going to start to see a real recovery. So there are 2 different ideas that we've invested in the past couple of weeks. They're about 6% each. They're pretty decent sizes. And that's sort of how we look at the micro, factoring in the macro. From a top-down perspective, last month we really just looked at the US. UK is not as strong as the US because they don't have 30-year fixed-rate mortgages, averaging 3.3% with 98% of people fixed in. So it's not as perfect. Inflation, certainly on the energy side, have been a lot higher in the United Kingdom. But now you're starting to see wages catch up and mortgage rates go down. Mortgage rates are also not as high, though, in the United Kingdom as they are in the United States. The US hit a high of 7.5% today, was it? In the UK, it's about 6.1% in and around that region as of right now, the average, when you look at a blend of 2 and 5%, and then you look at an average of loan to value of anywhere from 60 to 80%. It's about 6.1%, 6.15%. It's very attractive to me. Really, really, really attractive to me. And so we're looking at the macro, and then we're trying to line it up with the micro, diversify that risk, and give as much time as possible. And sometimes it does take a long time. Sometimes, not all the time. The longest I've been waiting for a return was Cameco. And that was 4 years, but it was in a diversified portfolio. And what ended up happening was the size of the position went down over time with the lack of performance while the rest of the portfolio pushed higher. That gave me an opportunity then in 2020 to do what? Bring the average cost way lower, because the weighting went from somewhere around 8% back in 2016 to somewhere around 4% in 2020, 3.5%. Was able to increase it pretty significantly and get that average cost lower, maximize the returns. And so there's a couple of those in the portfolio, like BioNTech as an example, as they realized their sort of vision of being a multi-product company. And if you stripped out the cash and you looked at the multiple today, okay, it's a little bit higher, jumped about 25% since its earnings. But previous to earnings anyway, the number was, it was about 4.5 times earnings, stripping out the cash. Early pipeline, acquired 2 drugs in the oncology space. It's not entirely a COVID play. COVID revenue drops down to about 600 million over 65s, purchasing in the commercial market, 250 million doses. It's a 600 million in net income on the bottom line. Exclude out the cash, you were paying 5 times earnings on the lows. Bizarre valuation. But the kicker in the company is it turns into a multi-product company. Malaria, oncology, they've got a melanoma pipeline. that's heading into phase 3 trials. They just bought 2 phase 3 trial drugs that we should get updates next year on. They paid $127 million for that. These can all contribute billions of dollars to free cash flow. So it hasn't worked as of right now, but in the case of Cameco, what do? Just wait patiently. And then when the moment comes, we strike average down, and then it starts to run. And that's sort of the way in which I'm looking at that. It's only about 1.6% of the portfolio. So again, over time, the rest of the portfolio in a diversified portfolio, it bought us time. It's given us another opportunity to get more attractive valuations. So that's the way in which we think about portfolio construction. I think it's a stock picker's market. I think there's a lot of volatility. So I think you got to be careful, and diversification will buy you some time as, I guess, the narrative and the story of a lot of these companies change. I'm going to swap on over to comments because there is a bizarre amount of comments here. So let's start off the top. Roman saying, always good to, oh, thank you very much, Roman. What's my view on the current market? Do I think any big correction is coming? If yes, how do you prefer to hedge? Look, as you guys know, I use Elliott Wave to try and determine a lot of this stuff. And so this is what I was expecting a correction. We got about 6% or so in the S&P 500. It came down to really where I thought it was going to come. I'm expecting this to continue pushing higher. NASDAQ, pretty much the same situation. Came down into around the region that I was expecting it, and it's pushing higher. I'm expecting the continuation over the next couple of months before another little bit of a correction. That's what my view is. If you want to know why I came to that conclusion, look at last live stream. Went over the macro. Consumers in good shape, 60% of the economy, 40% is U.S. government. U.S. government's not in good shape. So when RRP dries up, you're going to have to see some sort of monetization because I don't see any international demand for U.S. bonds. So I think once that liquidity that's still sloshing around dries up, you'll get back into an easing period. It won't be called quantitative easing; it'll be called something different. But it's like in Europe, they had quantitative easing, became unpopular, so they started to do not QE, which was called targeted long-term refinancing operation, TLTROs. They just changed the name, but it's the same function. So you're probably going to see something like that. I think that we had a correction, and that's sort of what my view is. Could be wrong, but that's sort of how I'm looking at it. Okay, so CVS. There was another comment on CVS as well that was on the eToro platform. Let me just read it real quickly. It's open on a different screen. It was just asking, how do I rate the news on CVS that dropped the stock by 10%? Okay, so that was a comment, and this comment is any updates or change in view on CVS, overstock, and do you have thoughts on SPGI? No thoughts on SPGI other than I think a lot of those companies are very overvalued, and unless, and they can drop. Look at Adyen, 38% drop in one day. Great company, high quality company, growing fast, high margins, 75 times earnings for a marginally slower growth rate can really crush you. And it's not that SPGI is massively expensive, but it is quite rich relative to everything else you can get. Like, I'd rather buy Lumentum at a normalized price to earnings rate at 8 times than I think SPGI might be closer to 30 times. So let's just pop on over here for a moment because the question was on CVS. So for those of you that don't know, recently news came out that the PBM business, so CVS is, they've got 24,000 pharmacies. They've got 44,000 pharmacies, and they have 25,000 pharmacies that are individual pharmacies that are owned by other people. There's 66,000 anyway in total. 40-something is owned by CVS, and the rest is individual pharmacies. And the PBM business basically negotiates pricing, etc., on behalf of all these pharmacies with the manufacturer of these drugs. So it's just economies of scale, bulk purchases, guaranteeing revenue for these pharmacy or for these biotech and pharmaceutical companies, and it's getting the best prices for the little guy as well. That's sort of the idea behind it. There's many different elements to it, but that's essentially what the PBM business is. They also have, obviously, the insurance side. There's a couple of other different segments of CVS, but this is the one that's very concerning. And the announcement was that Blue Shield of California were going to pull back from using Caremark, which is the PBM business that CVS own. And they have 4.8 million customers, and therefore the market dropped pretty heavily. And the market dropped pretty heavily for CVS. Now, we have a good average price. We're in at about 68. So I'm considering averaging down, and I'll explain why in a moment. But I'm going to wait for probably lower levels so as we can maybe average in a little bit. But as of right now, there's not a deep enough discount. But let's just look at this. The management responded to it. They came out and reaffirmed 23, 24 guidance. And this move is going to impact CVS in 2025. So it's in a couple of years. The full story wasn't in the headline, though. 50% of the business that was done with Blue Shield is specialty pharmaceuticals. And CVS are going to continue executing on that role. So they didn't lose all the business. That wasn't a fair reflection. What it's going to impact them is $50 million, which works out to be about 2 to 6 cents earnings per share based on the guidance. That's it, 2 to 6 cents per share. So the guidance, if you look at full year guidance, the normalized earnings would be 850 to 870. That's the normalized, and gap would be 653 to 675. Now, I'm not very good at math, but 2 cents relative to that's pretty damn low. So it sounds pretty scary, but Amazon were not moving into the pharmaceutical business. They overbuilt their transportation and infrastructure. Capital expenditures was $66 billion. 40% of that went into warehousing, transportation. And they overbuilt it for this specific reason. They'll be taking the contract for distribution of these drugs to the household. The small part of it that CVS were doing, Caremark will now give that to Amazon. There's a couple other companies that will take different roles, but it doesn't reduce complexity. It increases complexity because CVS are still delivering on specialty pharmaceutical. And then I think they brought in another 2 or 3 different players. So they've just made the system that was already complex more complex in the hope that they'll be able to save some money. So the way in which I look at it is it's not going to impact earnings for the next 2 years. I would expect pretty big buybacks over the next 2 years, which management have sort of suggested. And then in 2025, it looks like it's going to be a minor hit to their bottom line. The other thing is people don't really understand CVS. The business, the PBM business, is probably going to remain stable for a couple of years, and then it's going to kind of roll off. We're moving towards value-based care, and that was the whole point of the couple of acquisitions that they made. The star ratings, which is reimbursements from the government, the star ratings changed. And it's now more about value-based care as opposed to treatments, drugs, that sort of stuff. And so the whole industry is transitioning. And as they move, they'll be able to recover that star rating, in my view. Reimbursements will improve. The acquisition of Option Health, they're going to open 100. They have 100. They acquired 169 health centers. They're going to increase that to 300 in total. And every single health center is going to contribute $7 million in EBITDA. That's $2 billion in total EBITDA that's going to be contributing to the bottom line into 2025, 2026. And as they get that value-based care through those acquisitions, the star ratings improve, reimbursements start rolling back in. So 25, 26, I'm expecting the business to do a lot better. And I think that's what a lot of people miss about CVS, is that this is like the whole healthcare system in the US is transitioning. It's completely moving away from the system that they previously had. And how they're moving it away is star rating system, reimbursements, cutting your reimbursements and forcing these companies to actually change their ways. And so that's what crushed the share price, absolutely crushed it. And as it got down to about $68, it started to look pretty attractive, and that's why we bought into it. Going back to what I said at the very beginning, there's a lot of noise. Caremark drove the share price lower here. Is that justified? I mean, if management are being reasonable in their forecast saying it's going to be a $50 million hit, 2 to 6 cents in EPS, that's bizarre. That's a bizarre move. So I think that this is creating an opportunity, and I may average down pretty soon. So that's what my view is on CVS. We've only really just added to this back in June, was it? It was somewhere around here anyway. It was before that, maybe May. Somewhere around May is where we started to buy it, because I remember this drop here. If you remember, the industry got downgraded because of the insurance business and unrealized losses and blah, 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 blah. And then Elevance Health come out and they increased their guidance. Typical noise in the short term. This is another example. That there is another example. And then Elevance come out and they upgrade their guidance, and then the share price recovers, starts to correct, and then now we have another little bit of a non-event. And so we're just sort of tackling that sentiment at the moment. Eventually, I expect it to play out, but that's sort of my view on CVS. Do I think the bottom is in GoPro? What's the catalyst could drive it higher? So GoPro is interesting. I've got this is another one where it hasn't worked out, at least as of right now. But if we start to get signs of it improving, we can average down, get the average price lower, and then if the thesis does play out over a longer period of time, we should still make a lot of money. So this is the way the business went into COVID, and what they done was they took, let's say, 100% of their stock and they cut it in half down to, this is just an example, down to 50. Higher volume cameras meant higher margins, higher revenue, but lower cost to store and sell and ship these cameras, and a higher probability of converting the software that they had, which is the interesting thing that I really like about the business. After 2 quarters ago, the reason why we had these sell-offs was the management said supply chain risks from COVID are over, and therefore we're going back to the previous business model. It kind of makes sense when you think about it. And the reason why it makes sense is and the reason why it makes sense is because software business has 60 to 80% margins. And the camera business is lumpy. You sell a camera, it might be replaced every 3 or 4 years. It's hardware. It's a durable good. Software is recurring, $49 a year, storage, editing, all that sort of stuff. And so the high margin, consistent revenue is what they want to grow. So they had 100 million in ARR. They cut the cameras from just luxury, and then they added another entry-level camera. And then they massively increased their expected volumes. So with higher volumes, possibility of higher conversions on the software. And that's really interesting because it's higher margin, but more importantly, it's more consistent revenue. So the cyclicality of the business declines. And so they increased the number of subscriptions by 27% in the first quarter. I thought that was really interesting. So as of right now, going back to the previous business model, I was questioning whether the brand value had diminished. And the reason why they were cutting price is because prices were too high for those models and people were looking for alternatives. It looks like, whether that's the case or not, I'm not sure. But that's what my concern was. But on the latest quarter, it looks like adding a new entry-level price, cutting $100 off the camera, is actually working as volumes increase. And so that's kind of exciting. So it's way too early to make a judgment. But as the management said, they've got net cash. It's $500 million, $600 million business. They have $150 million in net cash, and they're guiding towards $300 million in EBITDA. So you'd have like access to $400 million, $450 million from cash flow and cash on hand. That's almost it's about 70 to 80% of the market cap. They'd be able to buy back a significant amount of shares while they reaccelerate growth. And that's what's really exciting. But again, I think the market's kind of lost confidence because there hasn't been much buybacks. They're talking about buybacks, but they're very tepid and slow at these valuations with net cash. And that's what I think is definitely worrisome, certainly for me. So I was worried about brand value, give it another couple of quarters. And I was worried about buybacks. Like, why are you not buying back stock hand over fist at these prices? So we'll see. It hasn't worked out as of right now, but in the next couple of quarters, we'll get a little bit more information. We'll see if these start to trend higher, and then this might actually be increased within the portfolio at much lower prices, and then the expected return hopefully is achieved. So that's what my view is on GoPro. It's just sitting in the portfolio at the moment, and we're just following it quarter in, quarter out. Thoughts on uranium, Palantir, and Tesla? No view on Tesla or Palantir. I don't own them. I do have a position in uranium, but I don't own it within the portfolio. And the reason being is, although I requested Cameco on eToro, when they actually listed it, it was on that peak there, around that peak there, $25 a share. So I've never really thought that it was a fantastic longer-term opportunity from when it was listed. And I do think it's a long-term winner. But here's the thing. This is all sentiment-driven. You have to understand the nuclear fuel cycle, right? So nuclear fuel cycle is 3 to 6 years. You know, this garbage of all of the utilities are going to come to the market at the same time, and that's going to cause the price to go up like 100%. That's nonsense. That just shows you have no idea how the nuclear fuel cycle works or the balance sheet of a nuclear fuel company. The operating margin of the nuclear segments of the utility is impacted by about 11 to 15% from the price of uranium. If the price of uranium doubled, these utilities that are broadly diversified wouldn't really impact them massively. So that whole view is really silly. So the fuel cycle, a lot of people were looking at the fuel cycle and saying the fuel cycle ends every 2 to 4 years. That just fits your narrative. It's every 3 to 6 years. So the cycle's a little bit longer than what a lot of people anticipate. And it's not going to impact utilities like what a lot of people think. And trust me, I am one of the most bullish people on the uranium market, but not at these prices. And I think a lot of people need to spend more time not listening to uranium mining management, but listening to utilities that actually buy this bloody stuff. Because that's where an awful lot of the confusion comes from. All this hype and all of this sort of stuff never comes to fruition because you don't understand the fuel cycle, don't understand the balance sheet of a utility, which is one of the first things that I think you should do if you get into this space. So the reason why I bring it up and why I say this is all sentiment is, check this out, right? So if we add in UX uranium, so this here, this is in percentages. I don't really want it in percentages, so I'm going to move it to new right scale. I want to show you something here. If you look at the peak here in uranium, it also lined up with a lower high. Look at the price of Cameco. It's running here on expectations of higher uranium price. Uranium hasn't even broken above this high here. So let's look at the break-even cost for uranium miners. $70 to $80 per pound is the break-even cost for uranium miners. Where we are as of right now is $58 a pound. We're not even in that area. So this is really just sentiment. We're not ready to run yet in uranium. And it's the same narrative that's been going on since the day that I invested in it in 2016. And it took me a couple of years to get away from that whole sentiment and really focus on what drives these, because it gives me a much clearer picture of what to focus on rather than get caught up in the hype. But it's not ready to run like crazy. And as you've seen there a moment ago, I think we're really at the end of this sort of 5-wave move here before we start correcting lower. And what drives that? I mean, expectations probably, underwhelming earnings. Why? Because the uranium spot price is at $58, not $70 to $80 to break even on cash flow for a lot of miners. But the minute we do get back up above $70 to $80, and we will, because we have demand increasing, and that's another thing, it takes 5 to 7 years to build a nuclear power plant. People are buying uranium today because France are going to increase the number of nuclear power plants. That's so dumb. That's such a dumb thing to do. That's not going to consume uranium for 5 to 7 years. And that's assuming that the plant is built on time. But that's where the market is at the moment. So I think uranium is a fabulous market to invest in, but the prices are completely unreasonable today relative to where the fundamental picture is. And those that are saying the fundamentals are so good are looking at a flawed view of the fundamentals. And that's why you're not seeing uranium prices explode. It's grinding slowly higher in an improving fundamental market. So that's what I think on uranium. I own Cameco, but I'm unwilling to add it to the portfolio as of right now because I don't see these as reasonably priced. I'll only add Cameco. I won't add any of the juniors. I think you can make enough money on Cameco. I don't think you need to really take huge amounts of risks to make a lot of money there. Would I adjust my media exposure and Warner Bros. Discovery holdings depending on change of price of other media stocks? Disney is testing $85 support, likely to break lower. Paramount? No, I wouldn't. And the reason being is, I mean, I know these aren't directly correlated, but they're both apparel, same sector, different industry. But if you look at Foot Locker today, it's got completely different fundamentals than Abercrombie & Fitch. And they're going in completely different directions. So it really comes down to the individual fundamentals. If I look at Disney, what's the problem with Disney? Disney's latest quarter, they lost 11.8 million subscribers on Disney Plus. 11.8 million subscribers. Why? Conveyor belt of content is just not there. And the quality of the content that they have been bringing online is questionable at best. So Disney's content is less than desirable, the new marginal content, and there's not enough of it. Look at HBO. HBO has 35,000 hours out of a total library of 200,000 hours. It's huge. Warner Bros. Discovery have different revenue mixes, including licensing. All the dusty old content that they have, 10 years old, that's fully amortized, that's been watched a billion times, that's licensed out. The licensing revenue is growing really fast. So they have this more consistent sort of revenue stream. It's a much better business in my view. So I don't really care what anyone else is doing. I really care about what Warner Bros. Are doing. And the thesis there is simple. Generate tons of cash flow, pay down loads of debt. That's it. And then the debt converts into the equity and the share price pushes higher. So when you look at Warner Bros. Discovery, they paid down $1.6 billion on the latest quarter in debt. And then they issued a tender before the earnings to acquire another $2.7 billion worth of debt. They're hoovering up debt. They paid down $8.5 billion or $8.9 billion since the acquisition. They're talking about getting back into investment grade by mid-2024. The multiple is going to increase on that alone. So it's just a matter of timing. And in fact, if you look at the year-over-year performance of WBD, and you look at that relative to Disney, they're both yielding completely different results. The fundamental picture is completely different. Year over year, there's been a bit of volatility, but Warner Bros. Discovery, an awful lot of the merger confusion is in the rearview mirror. And that's why I think it's performing a little bit better. But Warner Bros. Discovery is flat in the past year once we got rid of an awful lot of that noise related to the merger, while Disney is down 25%. Again, they just lost 11.8 million subscribers on Disney Plus in one quarter. That is insane. So I think it comes down to the fundamentals of each individual asset, and I think Warner Bros. Discovery is a better business. So I don't really care about whether Disney share price goes higher or lower. I care about what do I get for what I pay, and can I make money over a reasonable time horizon? And I think I can. I think the market's slowly catching on to it. There's their earnings. It was down 5% on earnings, which was bizarre to me, but it recovered very quickly and it pushed higher. Now we pushed lower a little bit further, which we could argue is just filling out the pattern here. But anyway, it pushed higher massively thereafter. Why? Debt reduction, converting to equity, and general sentiment. We went into a correction, which probably led to that pushing lower. But anyway, it is what it is. I'm pretty happy with it. What is the kind of economic environment you foresee where Digital Turbine thrives? Is this 3-year time horizon like most of the positions I enter? Do I see it as a possible 10x, 40x? Look, here's the thing about Digital Turbine. So Meta just came out recently and said what? They are testing downloads for applications in advertising. What is that? That's Single Tap. Single Tap, which is owned by Digital Turbine, they want to license it out. That business in and of itself it will be worth billions. And the reason being is, if you look at the problem that we have right now with the App Store, it's dominated by Google with Android and Apple with iOS. And what have they done? Well, they've decided that Meta can't use their tracking or whatever. Just as an example, they're charging a 30% extortion rate on people that generate sort of income in app if they've downloaded through the iOS store. Like, they're able to do whatever they want because it's a duopoly. If you own an iOS and you download it in the App Store, in the iOS store, you're kind of screwed. And a lot of people are being ripped off by Apple and by Google, not as much Google, but certainly Apple, for those reasons. How do you break up that monopoly? Well, what Meta are looking to do is advertises a product. Let's say it's a game, and you can download internally in that advertisement that application. It bypasses iOS and Android store, right? It breaks up that monopoly of a huge market, and Digital Turbine own the licensing of that. So when I look at it, that's slow to roll out. It was interesting on the latest quarter. They came out and said that obviously their expenses are going to increase. Next year, we're going to resurrect in growth, but they were very tight-lipped. They're integrating some of their acquisitions and some of their products, including Single Tap, with some of their, obviously, network providers like Verizon, etc. That's super interesting to me because maybe there's a contractual agreement where they can't speak about it yet. But we're starting to see Meta, as an example, test Single Tap. And we're starting to hear them say, listen, we've got to increase our capital expenditure to integrate these. In a year's time, if single tap really is rolling out, that's going to be gigantic for Digital Turbine because they only need really one big customer. That's it. And there's many different customers. Like you look at all these gaming companies that have advertising, you know, those games that are free downloads, but they have advertising to get sort of free chips or whatever in poker. Those companies as well, Epic Games and stuff like that, they're all opportunities for Digital Turbine as well. It's not just Meta, Snapchat, Pinterest. It's not just those companies. It's a big array of different companies that can license that single tap technology. And I think that's really, really exciting. It's not really contributing much to revenue, but if they got one customer, revenue would jump significantly. And in that case, if you do start fragmenting the App Store, of course it's going to be greater than 10x. It's completely mispriced in that scenario. That's speculation as of right now. There's no confirmation on that other than if you read between the lines what Meta are doing, if you look at what Digital Turbine own, and you look at what they said on the latest quarter, maybe they're moving towards it. Maybe that's getting closer to a reality, and that's super exciting. So I think that could it be a 10x, 40x play in the scenario where single tap is sort of licensed out to companies like Meta? Yeah, it is. It really is. So it's a very exciting one for me anyway. But they do have an awful lot of revolving debt with high interest that they need to solve for in the near term as well. Like it's not all rosy. It's not all just sales as well. Like the balance sheet I think will be fine, but they have a bit of work to do. But if single tap rolls out next year, that could solve an awful lot of problems where the deleveraging happens at a fast pace. They continue to pay off a little bit of debt every single quarter, which is good. But that's absolutely a possibility. Thinking of hedging with SQQQ for short term would be interesting. So I showed what my expectations were earlier. I think we were getting a pullback, which we got. So we'll see. I'm certainly not hedging anyway. You've made a video in the past about how to spot a market crash like a pro. Can you quickly run through these metrics? Okay, so the way in which I looked at it from a fundamental perspective, and what we would do is we would look at data, and I'll do this really quickly. ISM PMIs. So the ISM PMIs, the manufacturing report on business. Now I'll tell you why this is not as effective today, but the report on business, the manufacturing report on business, has a correlation with GDP, 85% correlation with GDP. So if manufacturing was expanding, it would mean that, like, let's say you had new orders, whatever. If manufacturing was expanding, employment would expand, capital expenditures would increase. That would then lead to sales and marketing of those products that ends up getting into the customer's pocket through delivery, just as an example. The process from a new order in a manufacturing report all the way to delivering it to the customer has tons of people touching the product. And that requires a lot of money being spent from everything from labor to raw materials. And so that's ultimately why that correlation existed. It still exists. It's quite a high correlation. And so generally what would happen is you would see manufacturing go into a manufacturing recession and employment roll over. As employment roll over, what would end up happening? Well, then you'd start to see at the margin spending come down. As spending came down, you'd roll into a recession. But well before the recession happened, what happened to the stock market? It would actually go down. So so when you looked at it from a fundamental perspective, that was the markets are future discounting mechanisms. At the beginning of that sort of value chain, the manufacturing new orders, as they start to roll over, hits headline, hits employment, hits sales, all that sort of stuff. At the beginning of it, as that starts to move through, the market starts to peak out, rolls over. Today, it's a little bit different because if you go back to COVID, and COVID's the answer to most of the problems in the world today, $7 trillion in fiscal stimulus, the majority of that found its way into the household's bank account. At the same time, you had a huge increase in demand, huge increase in inventories. Why? A lot of companies forecasted future sort of revenues based on artificially high demand. So what ends up happening? Well, look at Crocs as an example. We were looking at working capital a moment ago. They built up their inventory way too high. Rookie mistake. That's what they done. So what has to happen? They need to liquidate that inventory. And then what ends up happening? Well, as they liquidate that inventory, they're not ordering off the manufacturer. So the manufacturer then goes into a recession. But what ends up happening at the end consumer? Consumers filthy rich. We have tons of product that we overbuilt. So we're in a manufacturing recession, but we have a strong consumer with lots of cash and plenty of product. It's just not being manufactured in the near term. Bullwhip effects have completely screwed that cycle. And so although the manufacturing is at 46.4 and it's in recession, we're burning off excess inventories as of right now. So you're actually seeing working capitals improve across the board. And a lot of beaten down companies will actually start to look very attractive. And Abercrombie & Fitch would be one of those as an example. So up 120% on the year. And so that was essentially what I was alluding to. But that video was made pretty early on, maybe 2020, 2021, 2020. I can't remember. I got off social media in mid 2022, so it was probably 2021. So before we even had any of what's happening right now, that was sort of how I viewed the world. It will get back to that way eventually, but that'll be when excess savings deplete, when we start to see normal inventory levels. We'll get back to that point there. But the fiscal stimulus is having a big hangover even years later today. And that's where we are. So we're in a manufacturing recession, but to most people that focus more so on the numbers as opposed to how the mechanics behind it, they can't really figure out why the stock market's pushing higher. Why is it pushing higher? We're in a manufacturing recession. That makes no sense. Of course it makes sense. Unemployment is still very low. Wages are still trending at a very decent rate year on year. We have plenty of inventory. We have a cash-rich consumer. And I know a lot of people are talking about net savings, but they're not looking at the flows into money market funds. Deposits are going down. It's going into interest-bearing money market funds, which is going to pay the consumer even more than what they had in the household, in the deposits, right? So there's lots of stuff that's happening beneath the surface after COVID that's causing all these mixed signals, and it's allowing people to really run away with just bizarre theses. And you can't prove it against anybody if the market's moving in that direction. Like, look at all the narratives. Not to sort of dump on anyone, but, you know, there was a time where, you know, George Noble was the most popular person on Twitter. Very bearish guy. He's just unwound his fund. 12 months later, I don't know how long it's been open. And most of the theses that he was running with was more got to do with opinion as opposed to fact. But you're able to get away with it when the market's moving in that direction. You're not able to get away with it for long, though. And that's why it's important to really understand the mechanics of it. So pretty quickly, you recognize, oh, inventory are bloated. Consumer's still fine. The manufacturer ain't getting many orders. So if the manufacturer is not getting orders, there's a problem there. Fortunately, we bought a manufacturer, Lumentum, because of these challenges. But it'll normalize in the future. End market demand's way higher than the inventories that are being, or the customer orders. So you're able to find deals in this environment as of right now as it normalizes. But that was essentially the thesis behind that. Yeah, we have a lot to talk about still because there's still lots of comments. But yeah, we're an hour and 40 in. Let's see how far we get. Thoughts on office REITs? I wouldn't touch them. There's easier plays there. I don't think you need to make any difficult decisions today. There's lots of really good quality companies that are easy to understand at very reasonable prices. You don't have to get involved in office real estate. The problem with CRE is I don't think it's the end of the world there either, by the way. But the problem with that is the mortgage rates are every 5 years. The refinancing cycle is 5 years. So that's a big problem because over-leveraged players, some of them will go bust. And some of them will thrive and survive. And I guess your job is to figure out which ones thrive and survive and which ones go bust. That's a hard game to play. I would look at somewhere else. Yeah, so Eddie's talking about next 10 years index will be dead money. So it's interesting because this is the one thing that terrifies me about indexes is if you look at every single time in the past that we had huge amounts of concentration in holdings. Back in the 70s, we had the Nifty 50s. Remember the Nifty 50? Valuations got 60s and 70s. Valuations got very stretched and they were high weightings within the index. And as we rotate, there was lots of opportunities, but the index didn't go anywhere because they had high concentration to the Nifty 50 that was overvalued. A decade of no returns. If you look at the dot-com era, similar situation, decade of no returns, concentration got very heavy. Companies like Cisco, Micron, Intel, way overvalued. Some of those companies haven't even made it back to their all-time high. So you had a decade, as you've seen, rotation beneath the surface. Where we are today, it's about as concentrated as it's ever been. And I guess the question is, will the incumbents be disrupted, right? Because you have all these big, large tech companies. So far, they've been incredibly durable, but that's the question. Will they be disrupted? I'm not going to hang around to find out. I'll be able to find opportunities that are reasonably priced and be patient. That, like, you look at our returns this year, okay, it's not like, wow, it's not like whatever. I'm sure some people are doing a lot better, but we don't have huge amounts of AI or tech exposure. Most of our returns came from companies like Transocean, 60, 70% up. CleanSpark's up like 140% or something like that. We've had Capri Holdings, 55%. So we've been very lucky. Even Overstock is up 26% on the year, right? So we've been very lucky to avoid a lot of the speculative plays, but we've been very lucky to still generate decent returns. And I can do this for the next decade. I can find these type of companies and still put up decent numbers. I don't have to be concentrated. That's the way I look at it. So I agree there's a risk of that. And every time we had concentration in the past, Nifty 50, 60, 70s, after the dot-com era, into the 2000s, we had a lost decade. And we have concentration much higher than .com and way higher than the Nifty 50 today. So think about that. ASO, I don't know anything about it. Well, I know that they're in the auto parts space, but it's already kind of ran a lot now. No, Academy Sports. Okay. I was wrong. What did I think it was? I'm not sure. I don't know anything about Academy Sports. Never come across the company. Could be a winner, but I'd let this play out. It looks like there might be some more downside yet. On the last stream, you said that Overstock could 2 to 3x their revenue because of the Bed Bath & Beyond rebrand. Any particular reason for this belief, given Bed Bath & Beyond only generated 1.1 billion in e-commerce sales last year? So that was from their daily active customers. So if you look at the daily active customers were double, it wasn't just a daily active customer list that they got. They also got people that might have bought one thing over the space of maybe a couple of years. And there was 40 million people in that basket. So what they're doing right now is doing highly promotional activities. And that is hopefully going to draw in more customers. So based on the active customers that they acquired, it would double the number of total active customers that they have. And then hopefully there will be an opportunity for possibly increasing that even further. That's sort of the view. You're down and the market's up. That's all anyone needs to know. Collection of garbage businesses. All right, well, let's have a look. How are we doing? So Mike, unlike you, my good friend, you don't put your numbers up publicly. We're at 19.19%. And we're up 1.43% on the day, meaning year to date, we're at 21%. So let's have a look. Let's see if Mike is right. Year to date, S&P 500, 15. Let's adjust it because Mike talks about dividends as well. Adjusted for dividends, 16%. Looks like we're beating the S&P. Year to date, or SP, equal weight, adjusted for dividends, 5.09%, Mikey boy. Small caps, 6.34%. And the only one that's beating us out of the large indexes is the QQQ. And I don't own any of those companies. So thanks very much for your comment, Mike, but have a great day. Aaron, do you have a fair value estimate for AMR? AMR announced they'll be discontinuing their dividend and using those funds for more share buybacks. They must feel their company is undervalued. AMR can go into a massive, short squeeze. And the reason being is these guys are just doing all of the cash flow that comes in the door. It's four times price to earnings. All the cash that comes in the door is going into buybacks. They're not doing the dividend, as you mentioned. They're not doing their dividends anymore. Not that it was very much anyway, but it's all going into buybacks. So you have a situation where they're hedged production at $195 a ton. The market is below that at about $150 a ton, but they'll generate over $2 billion. $2 billion in free cash flow, which was close to their market cap not that long ago. So you have speculators like myself, like you, that are buying the stock. And then you have the company that has $2 billion in free cash flow that's also bidding on the stock, which is equal to the entire market cap. So the fair value is going to be really difficult to find. But this has been, again, another one Mike probably has never heard of. But this one here, as you can see, has been performing very well while the rest of the market's been doing very bad for that capital allocation strategy. So if you look at this, year to date, as the prices were under pressure, BTU decided to pay out higher dividends. Let's have a look at a relative, and they're slightly different end markets, but if we just did, year to date, Peabody's down 12%, AMR is up 36%. Why is that occurring? Well, Alpha Metallurgic Resources are buying back their stock. They're the natural buyer. So it could be, as the share price continues to push higher, more speculators start to bid on the stock. It could be a scenario where it could turn into a big, massive short squeeze. Not enough outstanding shares. It's already getting very lightly traded. There's only like 13 million shares outstanding as of right now. So where we are as of right now, I'm following the Elliott wave chart, which will bring us up to 253. I think we'll just follow it as we go, but that's sort of what I'm looking at. Thoughts on Adyen? I'm only looking into it now, so I don't have any real views. I'd take the S&P 500 over Rob's portfolio any day. Anyone to bet that he'll underperform on a 5-year basis, I'll take it, Mike. Let's put your money where your mouth is. 40% weight, okay. Not against stock picking, just think Rob sucks at it. Thanks very much, Mike. I think we're a little bit past the childish behavior at this point, Mike. Show me your results. I'll tell you what, I'll put my portfolio against your portfolio. How about that? Let's see if you know what you're talking about, because all you're doing is talking smack. Buying Foot Locker, Adobe, and fine, explain, okay. Fritz, is there any company that I own that I could own forever, a business model that ever had bad management, can't screw up? Management changed though. So I don't believe in owning businesses forever. I still have a stake, a smaller stake. I cut the position a bit in Cameco, but I still have a smaller stake in Cameco. I bought that in October 2016. So still holding it 7 years later. So I could hold stuff for long periods of time, but it's not something that I commit to. It really, it's just an ongoing basis. Did I miss Overstock? I'm not sure if you have a question. I haven't underperformed the S&P 500. Let's just pull it up because I think Mike is making it up again. Let's just have a look at the audited track record of the portfolio, Mikey boy. So this is where we are as of right now, Mike. Sure, I'm not outperforming by much, but I'm outperforming by 3% after smacking the S&P 500's butt in 2021. Sure, took a hit in 2022. But back beating it, and I expect to continue that. So wrong again, Mikey boy. And that's a third party audited by FactSet. So there you go. Mike taking another L. Eddie, well, S&P have one big problem right now, like all big indexes. Okay, so I'm not talking about the index anymore. It's all speculation. Mike, you can put up or shut up, I guess. All right, let's get past Mike here. Thoughts on PayPal? Okay, I don't own it, so I'm not going to talk about it. Okay, blah, 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 blah. Okay, I think we're past all the comments. It just looks like. I've been following for a long time, and you're the only person I watch for this type of content. Thank you very much. Pedro, what do I think of GoPro's latest earnings? I mentioned that a moment ago. I think there's signs of improvement. The average sales volume has increased, obviously. Naturally, there's a lower price camera. But the 27% increase in subscriptions is kind of interesting. So I think it needs another couple of quarters before we can really make a judgment. Okay, now it's starting to get a little bit messy. There's just lots of comments that are off topic. They did buy two companies. Was it not Option Health? I know they bought Oak Street, but they bought two different companies. 1 second. That Option was one. Signify, sorry. Option Health. Why do I know Option Health? That was Amadeus. Okay, same industry. Signify Health and Oak Tree, and then it was Option was Amadeus, the acquisition there. All right. What's the bull case for Expo? I'm not sure. Mike, I don't know why you bother listening. Ready annual report, and when you understand before war, they're trying to do it. Okay, so you read the okay, that's on for Expo. Okay, this is really messy conversations. I have CVS. I think that industry will. I mentioned CVS a little bit earlier. There was a comment on it. The healthcare system in the US has gone through a sort of structural shift, and I think once they overcome that, the way in which CVS are approaching it is through M&A. Part of the way in which Walgreens are approaching it is through digital infrastructure investment. So they're different approaches, but I think they should do well. Why wouldn't Meta buy Digital Turbine then? Maybe they will, but it's small. Like it's a small fry for Meta. Meta's like $1 trillion business. Digital Turbine's like $1 billion business. They can license it for peanuts. It'll be massive deal to Digital Turbine because it's very small, but it's not going to really move the needle for Meta, right? So it could happen. I'm not saying it can't happen, but it's not going to really move the needle for Meta. It's not a very good look for Overstock. I mean, look, it's up to you. Update on Warner Bros. We spoke about that. Overstock back 24. What's next for this company? Overstock's pretty simple to understand. Furniture business. We spoke about it every single month. So Overstock is a furniture business. They bought Bed Bath & Beyond. The rebranding, the name's going to be Bed Bath & Beyond. They bought 2 million, or they doubled their active customers. I think it was 20 million, and they have access to another 40 million customers. So Bed Bath & Beyond is the new Overstock, and then at the margin you have the portfolio companies. So look, Raz, I'd encourage you to go and have a look at the fundamentals of Overstock as opposed to assuming because another investor is invested in it, it's like a good or a bad stock. If Mark Cohodes could move the needle, I wish he would, because it hasn't really been a great performer for a while. Rob just showed the stream. You have mentioned CleanSpark yet? So have I mentioned CleanSpark? No, actually, there was a comment on CleanSpark. Sorry about it getting a little bit messy, guys. I'm gonna block Mike. It's a waste of time. Sick of reading his comments. Stupid comments all the time. There was a comment here on. Yeah, here it is here. Do I have any concerns on CleanSpark management? I remember you getting pissed about a vote concerning compensation. And do I still hold my private investment in the stock? Second question, when will I invite Hugo on the live stream? Okay, so that's different. I actually sent Hugo a message earlier. He said he can do it next month. So that could be interesting. We might talk about solar or something like that. Cybersecurity, I know that's where Hugo's investing. So I might see if I can sort of get any insights off him there. On CleanSpark's management, yeah. So my concern on CleanSpark management was they had issued plans to increase the number of outstanding shares significantly. And as you increase the number of outstanding shares significantly, what's the problem with that? Well, if the return on the investment from the raised capital is bad, our shareholder returns are going to suck. But the second part of it was tied to stock-based compensation. So the way in which they set it up was if they do mergers and acquisitions and the outstanding shares increase, they're incentivized to do that because they get more stock-based compensation. Build a bigger business, get more shares and stock-based compensation. That's what concerned me. If you look at the deals that they done, at the very trough of the cycle, they went out and bought all the supply for 5 months for the S19 Pros. They're the most efficient so far in the market. It's going to be a more efficient one next year, but they have the best efficiency because they have the best miners. Fully paid for up to 16 exahashes. So they tripled the business, and the fully funded cost of that tripling of the business is a doubling of the outstanding shares. So they doubled the outstanding shares, but tripled the exahash. I think it's a pretty good sort of deal, and it gave me a little bit more confidence in their deal making. They're also really, really, really good at managing the energy costs. They've been going with variable costs for a while. It's nuclear as well, so it's pretty low base load. So strategically, they've been building out in and around Georgia, which is mostly nuclear, which is, again, low cost, stable base load energy. And I think they're doing a really good job. So I think they're going to cool down, build out the exahashes to 16, and we'll see what happens from there. But I was concerned about it because before all those investments are done, the incentive cost bias is, let's do deals, let's double it, like let's increase the outstanding shares, and then our compensation goes up. And that would enrich insiders, and it would come at the expense of you and I. That concerned me. But these guys are founders as well, and I guess I didn't give them much credit for that. And I think that the deals that they made were pretty good. I really do. So with CleanSpark, what's my view there? So this is how I'm viewing CleanSpark, and Bitcoin in general, I think is probably close to bottoming. But I see this it's either corrective from a technical perspective. Fundamentally speaking, they're going to be like, if you were to look at this in tandem with Riot blockchain, adjusting for exahash, right? So Riot blockchain have ordered up to 24 and another 6 exahashes, or another 8. They were 16 or 15.9, something like that. And they're going to get up to 24. So they haven't paid for that. So that's going to come at an expense, maybe equity, maybe debt, not sure. Either to buy those miners or in order to build them out. So that's going to come at a cost. But anyway, if you just excluded that, reduce the market cap of Riot by, I think it was 25 or 30%, what I done, the fair value was somewhere around $11 at 16 exahashes. That's what the market's willing to pay for Riot. CleanSpark are still building up towards 16. They have all the machines. They've got all of the expenses paid to build it out. It's just a timing thing. But they're at 9 exahashes right now. There's another 7 exahashes to come online. That's not reflected, in my view, in the share price. And so I think slowly as that exahash comes online, the market cap starts to improve. But I think they've been executing very well. And I'm very happy with the performance. And as I look at the chart structure, I think it's just a cyclical correction. Excuse me. Metafast can be interesting in next 2 quarters if they manage to deliver at least some growth. Yeah, I mean, they've got that 15% margin, 15% growth by 2025. They've just introduced new proteins and amino acids into an adjacent market. They've got 1 million customers. It's a complementary product. And they've done a study on an awful lot of these drugs that are coming out from Eli Lilly, etc., weight loss drugs, that they've come to the conclusion that it's actually complementary because that weight doesn't stay off without a balanced and healthy lifestyle, which is what Metafast sell. So it's actually quite complementary. And I think as we get into next year, at the margin, just by implementing new products, whey protein and amino acids, they'll be able to get some sales there, and it should bump it up. So it's very interesting. But find another business that's trading at about 8 times earnings, 100% return on invested capital, meaning all the free cash flow that comes in the door goes into your pocket. And they're paying out like 7-8% in dividends. They're buying back stock. And they still have cash left over. It's a really weird one. On the latest quarter, they done $40 million in net income. 18 million went out in dividends. 22 million was added to the cash balance. Cash 2 quarters ago was at 87 million. Today it's at 123 million. It's a cash machine. It's a beautiful business. And if interest rates go up, fine, whatever. It doesn't impact their business. From a balance sheet perspective, might impact their consumers. It's not cheap. It's $400 a month for their products. It's not cheap. But they have 1 million customers and they're very successful. So introducing new products that are complementary, I think, would be very interesting. There was a day last week where BRK was up 3% on the day and Apple was down 4% on the day. It might have been Apple earnings. It was hilarious. Thought the same thing about BRK. Okay. S&P or you? I know where my money is going next. 10K. I really appreciate it, Derek. There's 2 more questions on eToro. Yeah, there is, but I sort of answered those. So the other questions were didn't receive the notification. Discuss theoretical returns. Okay, from the Turtle program. So that's really a difficult question to answer because that program shut down after the 70s and 80s. You had a high volatility. And so the 70s and 80s are going to yield a different return than the 2000s and 2010s because volatility collapsed. I mean, if you look at VIX, like trend following is really only good when you have high volatility. And if you look at the VIX over the past sort of, like if you just look at it over the past couple of decades, there's not, outside of this period here, there's not a huge amount of high volatility. It's a little bit here, but most of the time it's low volatility. And so maybe we go through a decade where volatility is a lot higher net. And volatility doesn't mean necessarily prices have to go down. It just means that the daily moves are going to be a lot wider, the distributions. So if we do get higher volatility, those returns will be a lot better. And the reason why I'm not putting a specific number on it is because I believe in the 2000s, 2010s, it really depended on what market you were invested in, but the returns were like single digits. Whereas if you were investing in commodities back in the 70s and 80s, you were making 60 to 80% a year. So that model only works with high volatility. And the problem that most people make is the Turtle program is so widely known and it's quite exciting for a lot of people. But if you don't understand how it works, it's looking at average true range, it's looking at moving averages. That's all well and good if the volatility is there. Most people that transitioned last year to trend followers, you know, once it goes above the 200-day moving average, we're going to buy it. And once it breaks below the 50, we're going to sell it. The problem I have with it is if we have a look at this, there's a 200-day. If you have a look at this, let's turn that on, go to the day. With the volatility that you're seeing, I mean, you're missing a big chunk of, if you've got a fundamental view on the valuation, you're missing a good chunk on the opportunity there. I guess the good side, the one thing would be that you get out pretty close to the high, you're out of the markets and you sit tight. I guess that's a good sign, but I don't know. I've seen some companies, certainly if you're looking at individual companies or more volatile markets, I mean, you can see these go way below the 200-day moving average. Like during COVID, for example, this is probably a better example. I mean, it goes below the 200-day moving average. You get out, it drops like 20% from there and then recovers and you get back in at the same price. You've missed a huge opportunity there. There it is again back in 2019. And I've seen that happen so many times. I could get incredibly frustrated with low risk, sure, but going through long periods of time without making money. Like it's not even a case that you have an opportunity there by looking at the S&P 500 to really make money. You're selling here, you're buying back here, you're selling here, you're buying back. You're just chewing up fees. That's the thing when you're looking at the Turtle Trader program and trend following, it's all entirely about volatility. So maybe like digital assets might work. So yeah, we spoke about CVS. So outside of the copy, I have 3 Overstock, Vonovia, CVS. CVS is compared to Overstock and Vonovia long-term. Oh, is it? Yeah, it would be. I mean, look, if it gets, everything's for sale. If the valuation comes to in a very attractive price, will I sell it? Yeah, absolutely. When I bought the Taro company, with the expectation of holding that for a couple of years because the forward expected returns were expected to be 16% per year, right? Compounded, 16.5%, which I thought was really good. Now we bought into this somewhere around here and we sold it somewhere around here. That's like 5 months later, but it was up about 40%. And so the expected return from here, certainly on the way in which I valued it, was way lower. And although it didn't crash or anything, you know, it's kind of just digesting that valuation. So everything's for sale. If CVS was to go up pretty aggressively, would I sell it? Yeah, I mean, I'll sell everything at the right price. Everything's for sale. So I don't commit a lot to that view that stuff can be held for 10 years. It's a lot more nuanced. Bigger picture impact from CVS. I already went over that. Okay. There's 2 more questions on eToro. Okay, I got that one. Baxter spinoff. will be ready soon. Can you talk a little bit about that? Yeah, Baxter spinoff is expected to. So there's two things going on in Baxter. It's a major corporate event that's happening here where you have the BPS business, the Biopharma Solutions is being sold for 21 times earnings. It's generating, is it $3.25 billion? But it's, 21 times earnings, what it's selling for. That's going to go into debt reduction after the Hillrom acquisition. So that's going to reduce debt. And then they're spinning off the kidney care, which is going to be called, I can't remember the name that they're going to call it, but that's going to spin off in a tax-free manner. And we're going to get shares of an individual company. And then the company that's left over. So this year, the Biopharma Solutions was a non-core asset. They sold it for $3.25 billion in cash. A private equity firm. That's going to raise some cash, reduce the debt. So that's going to save $100 million in interest expense. And then there's going to be a spin-off, which we get shares of, and then 3 individual vertically integrated, what they call GBUs, global business units. And there's going to be presidents or CEOs of each different unit, and they're responsible for their own P&L. And so that should improve the margin, cutting costs, etc. So you have this corporate action should reduce debt and also add shareholder value. Like this is trading at 11 times earnings. They're spinning off a part of the business that's trading at 21 times earnings to reduce the debt. The systemic risk profile of the business goes down. Maturities get pushed out, not that they need it. And then they can also get margin expansion as they start to turn around into late 2024. And then they start repricing all the hospital beds and everything. And then it gets really exciting. So that's what you're seeing right now from Baxter. So as of right now, yeah, we're expecting that spin-off to happen. We're expecting the Biopharma Solutions business to be sold into the end of the year. And we're expecting the spin-off to happen in H1 next year. So that's not happening now. That'll be next year, but the sale of Biopharma Solutions is happening soon. How am I feeling about Warner Bros. Discovery and Overstock? Sorry if you covered them earlier. I did cover them. Feeling really good. I haven't really changed my view. We didn't add that long ago to Overstock. We bought Overstock. I think we paid $19, somewhere down around here, which I thought was a good price. And we got our average cost down. We've got a $35 average cost. So we were briefly up on this for a period, but we went into a correction, pretty steep correction. But I'm expecting this is a wave 2. So I'm expecting we start at wave 3, what gets us up there. Possible outperformance on the Bed Bath & Beyond acquisition. Analysts only think it's going to add $200 million to revenue. I think it's going to be a lot more than that. And if it beats it by a very marginal amount, I think the share price does very well. So I'm very excited about Overstock. I think it's starting to work. And with Warner Bros. Discovery, I mean, fundamentally speaking, they're doing everything that I would have wanted them to do. They're generating lots of cash flow, managing their working capital very well, and they're paying down debt. And so, although there's a strike going on, I think that'll be resolved before it really becomes a problem. They've got 200,000 hours of content. They'll be able to mix it up. Still seems to be a cash cow, just a story of mean reversion in its growth. Yeah, so Dan Chard is the CEO over at Medifast, and he's a super interesting guy. So Dan Chard took over the company back in 2018. So I think it was like early 2018 here. And he basically, he turned the business around in that he created a flywheel. So previous to that, they were just a supplement business like Weight Watchers and stuff. And then he added a new element, which was what's known as Optiva. And Optiva was a coaching business where 40% of the margin on the products were going as payment into the Optiva coaches. And that was creating a flywheel. So they had, I think they have 55,000 coaches as of right now. And those 55,000 coaches were reaching out and doing their own marketing. And that was leading to this fantastic flywheel effect where they got more coaches, more customers, more coaches, more customers. They built out Jason Pharmaceuticals is the pharmacy side of the business. They built out Jason Pharmaceutical to increase the output. And with that, if you have a look at the performance, so the reason why I bring that up is Dan Chard took over in 2018. This was essentially what Dan Chard was able to do for the company. So these are pretty bizarre growth rates. So if you look at 2018, 66% year on year, 42%, 31, 63. And then in 2020, because so much growth was brought forward here in 2021, what ended up happening was, one, they maximized their output on Jason Pharmaceutical. They didn't really have much more capacity. But secondly, generally a customer would last, I think it's something like 9 months or 12 months, and you started to get a little bit of churn, but it was coming off one of the highest comps that they had. So if you look at the growth in revenue, 930 million up to 1.53 billion, that's 600 million. Go back to 2018 when Dan Chard took over. It was a $500 million in revenue business. They done more than that entire business in 1 year in 2021 after COVID. And so part of the slowdown was comps, as well as that inflation put a lot of pressure on their output, and those comps are impacting them on the upside. So where we are as of right now is they're redesigning the business to get back to 15% growth, 15% operating margins, and they want to do it by 2025. I think these estimates are probably too low, but there's only one analyst covering it. And they're like, I wouldn't really read too much into the estimates because they can fluctuate a couple of $100 million on the top line, plus or minus every couple of months. And so I wouldn't read too much into it, but basically they're looking to resurrect growth, get back to about 15% growth on the top line with 15% bottom line margins. And that's where it gets really exciting because the company's not really priced for that at all. It's priced at, if you look at its enterprise value, right? Its enterprise value is 790 million, $913 million in market cap. But if you look at its valuation, it's trading at about 15 times earnings. That's based on those estimates, but that fluctuates. That could be anywhere from 9 to 20 to 6. It really depends. There's only one analyst covering it, and it changes. It's quite wild. So based on its market cap, it's 15 times, but based on its enterprise value, because you have to remember they're doing buybacks and the total return would also factor in dividends, it's 790 million. So they've got 123 million with no debt, or 147, excuse me. They've got more cash than I thought. They've got $147 million, and the cash balance continues to grow. And the cash balance continues to grow as dividends. They've paid out $73 million in dividends this year so far, bought back $13 million worth of stock, repaid $27 million worth of debt. That's what they've done so far, $113 million. That's the last 12 months. And if you look at the balance sheet, last 12 months, the cash balance is at 147 versus probably 100 million. Cash balance went up 50 million. So cash is going up, paying down debt, paying out huge amounts of dividends, buying back stock. It's a cash cow, but there's question marks surrounding how effective these Eli Lilly drugs will be. But if you listen to what Dan Chard actually said, if you go to transcripts on the latest earnings, this was covered. We have to start, we said, simultaneously. 1 second. These new issues. We expect 24. We're glad to continue. Finally, before here it is here. I wanted to give you a few more thoughts from Optiva convention I mentioned a few months ago. No, that's not what I wanted. Maybe it was in one of the questions. Basically, they've spent money on research and development, and they've come to the conclusion that this will end up being oh yeah, here it is here. So that's inclusion of one of the considering GLP-1 drugs, prescription drugs. We've done some quantitative research to better understand. This is among that of our target customers. 44% don't want medically supported weight loss, and 41% do. So there's a big chunk of people that won't take a pill, 44%. But what they found was, the good news is related to this, is that we tie back to what we launched, the convention of well pilots. Okay, here it is here. Whoever 40%. So that's significant of our target group. The second thing is that's positive for us as individuals who are going on these drugs. And this just comes from our quantitative research as well. They're looking for guidance, and specifically guidance from someone who understands where they're having gone through something similar in terms of weight loss journey. And we believe that positions us very well for our coaches having the majority. So basically what he's saying is that this here is, after their quantitative studies, they've come to a conclusion that this will actually probably end up being, it's not that everybody wants these drugs or they're very comfortable putting drugs in their body to lose weight, but 44% of them won't take the drug. That'll go to Medifast. 41% will take the drug, but will also do it in conjunction with a healthy lifestyle. I mean, if you're trying to lose weight, if you're eating too many burgers, getting rid of the calories, the feeling for wanting more calories is good, but I'm pretty sure that makes a lot of sense. I don't know. I'm not in that shape. But anyway, they've done a study and it looks like it's going to be more complementary, which is very interesting. So yeah, I think it could be very interesting. Any concern about MDRX not providing their 10Q? So this is not new. So if you're, well, maybe you don't, but if you go back to last year, they found out that they had miscalculated some of their revenue and they had to restate it. And there was an 8Q here that says, it says on August 16th, the company received a notice. Okay, so May 18th, the company plans to submit an update. So basically what happened was they had the software that they were testing. They tested it on their own company and it replicated different receipts, meaning that the revenue was bloated by, I think it was 1.6%. So they counted 1.6% extra in revenue, meaning last year's numbers were wrong by 1.6%. Not huge, but they have to go back and spend money restating all those financials. And so they needed a quarter or two to restate them and figure out where the solution was. So we've known this for a couple of quarters. That's why it's not a very big position, but they're expecting to file before August 31st, their 10Q, and the 10K, which was supposed to be filed prior to September 18th. And that's been accepted by NASDAQ. So it's not something we don't know about. And that's why I think the share price has actually been drifting higher over the past couple of weeks, is because it's more of a non-event. We sort of know they're known risks. Yeah. Okay, guys, we've gotten to the end of the questions. 2 hours, 16 minutes is not that bad. Our portfolio of crap companies, according to Mike, it's doing pretty well. So I'm not disappointed. I think we're doing fine. How do I value the war in Ukraine's impact on the markets? Seems like no one cares anymore. So it was a war of attrition, and it looks like it's probably going to transition into a forever war. Sorry, Patrick, I'll get to your comment in a second. It's probably going to transition into like a forever war, unless the Ukrainians can break through, and it's probably going to transition into maintaining the current land markings. There's been a number of studies done that shows that Russia have lost so much equipment and manpower in this war that they can defend Russia from any invasion, sure, but they can't project power like they have in the last decade, or the last couple of decades. And so Russia has kind of just kneecapped themselves, and it could turn into a kind of forever war where it's maintaining borders and nothing, stalemate, sort of, kind of like what happened in Afghanistan. If that happens, the demand for oil goes down, manpower starts to slow down, you would see a slight normalization, but look, I don't know if that's going to happen or not. I have really no view there. What I do know is everybody's still looking at the problems that we've seen yesterday. And the problems that we've seen yesterday were oil supply in Europe. People looked at Germany and said, Germany are so dependent on Russia. And not one person took a step back and said, Germany have loads of high-grade human capital. They're bloody good at manufacturing. And nobody foresaw them building an LNG terminal that would typically take 5 years. Nobody saw them building it inside 3 months. So now you have shipments of LNG coming in and plenty of storage to store it, to diversify the energy system in Germany. And then you have mandates for solar panels on new builds moving forward. Certainly in Berlin, all new builds need to have solar panels. So you're diversifying away from Russian gas with US LNG, which is going to be more expensive for sure, but the supply of gas is going to roll in. You're not going to see energy prices go up 10 and 12x. And so a lot of the challenges that we've seen, a lot of those have kind of dissipated. As well as that, if you go back to that period, ExxonMobil came out and said, listen, we could start fracking in Germany tomorrow, and Germany could be energy independent with their own fuel, but they don't want to. There's no political will for that. And so in order for something like that to happen, that kind of political will, you need to break the back of the household. Maybe energy prices do need to go up 20x, but there are solutions there, right? Germany has plenty of areas that they could frack and actually be energy independent, but there's no political will. And so I'm not saying it's the right decision or the wrong decision. I'm just saying that there are solutions to the energy problem. Fracking's pretty simple. It's drill a hole, fill it up with sand and suck the oil out. Frack, obviously, fragment that hole, fill it up with sand, suck out as much oil as possible. It's not really that difficult. High-grade human capital could be imported from the Permian Basin, which are certainly the Bakken and the Eagle Ford, which are over-drilled. There's plenty of people that have skills in the US that could come in and show them how to do it. Look, I'm not saying that's a solution. All I'm saying is everybody is saying how bad Europe is from an energy perspective, and nobody's looking at the increased capacity, and nobody's looking at the diverse nature. Certainly in Germany, they'll never be the manufacturing powerhouse they were because Russian oil and gas is way cheaper than bringing LNG in from the United States, right? So they'll never be able to produce at those low costs. But you're starting to see consumption slow down, diversification of the diversification of the power grid. Like there's lots of stuff that happened. There's lots of stuff that happened that people seem to think that this is the year. This is the year it falls apart. So there's two things. Germany can't really project power today. And as well as that, like on the border, you've got, like Poland's a pretty big military. Like there's a lot of countries along the border there that have a lot of reasonably strong military to protect themselves. You know, it's not like there's a lot of stuff that's going into it that I think a lot of people are foreseeing. Energy bulls are like, oh my God, Europe is so screwed and it's going to become a vacation land, blah, 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 blah. I mean, the drunk guy down at the bars is probably what the view is. Again, just like housing crash, stock market crash, all this sort of stuff last year. 1929, it just doesn't happen. It's usually more nuanced. And my view is not that Russia-Ukraine doesn't matter anymore, but the risk was concentration, and that concentration's gone. And the risk was extending the war. And you could absolutely see them extend the war with nuclear weapons, for sure. But, you know, I'm not reading too much into it because if it goes nuclear, I mean, it doesn't matter if I bite a dip or whether I don't. The world changes pretty significantly. But outside of that, I think there's a lot of stuff that's going into it. Really appreciate it, Fritz. Patrick was asking, any thoughts on STLA? Looks cheap. Not sure if we are top of cycle. Yeah, I don't know much about this company, but it does screen out cheap. I haven't looked into it. It looks bizarrely cheap, actually, on a number of different metrics. It does look bizarrely cheap. $1.3 times enterprise value to EBIT. I mean, not a lot needs to go right with this company to make a lot of money. Strong rates of return, so plenty of cash left over to, well, again, it's a cyclical business, right? They manufacture cars, no? Automobiles, engages in engineering, manufacturing, distribution, sale of automobiles. Opel, Lancia, Vauxhall, Peugeot, Maserati, Jeep. Yeah, they've got lots of brands. Lots of brands. Not the best brands, but the Alfa Romeo crowd are hilarious. I think these are high-end luxury, but my mom bought an Alfa Romeo because she thought it looked good. I swear to God, they are the biggest pile of crap I've ever seen. But anyway, it's bizarre. Not a lot would really need to go right for this company. Analysts are forecasting flat growth, margin compression, but even with margin compression, I mean, on a forward-looking basis at 1.3 times EBIT, not a lot really needs to go right here. So why is it trading so cheap? Have they got some sort of weighted average diluted shares outstanding? Okay, so why did the shares outstanding explode? They're up massive. Why are shares outstanding increasing? I don't know. Dividend, massive dividends, 4.3 billion. Holy hell. $1.5 billion in stock buyback. But why? Okay, so capital expenditures are up massive. Where did the cash come from now? Why did the outstanding shares, was there a cash acquisition? Yeah, 21.7 billion. Yeah, there you go. A lot of that was paid for with debt, but even still, it looks bizarrely cheap. I don't know why. I don't know. I don't know. Don't agree about Ukraine. Next year will be over. I'm following the war very closely. Russia's having huge problems with equipment and frontline. Just gonna yeah, look, and that's the thing. Like, there's lots of things that can happen. That's not my area of expertise. I think I should just focus on what I know and what I can do. And I can make a lot of stuff up. Trust me, and I can make it sound really good. But it's not going to help me. So I can look at different individual companies. I can listen to what ExxonMobil are saying. I can look at the changes in manufacturing through company infrastructure plans, like the LNG terminal. I can look at policy in Germany and see, like, each new builds at the margin. Like, you're going to end up being able to pump up the prices a lot more by adding in heat pumps and solar panels. We own Vonovia. The return on investment to add solar panels and heat pumps to the property by increasing the rent makes a huge amount of sense. So they're doing it. So there's a lot of existing residential and new residential that will have solar panels. That reduces the risk then on gas. And then the gas imports still coming from Russia, parts of it. And also you have LNG flown in on boats from the United States. And so there's lots of stuff that can happen. I really don't know. Yeah, there's lots of stuff that can happen. I'd like it to end pretty soon. I'm not a war hawk. Crocs, we're back in. We sure are. We finished adding to it today. I think we have an average price of 97. And so far, yeah, there you go. We've got a pretty decent return. Eddie, thank you very much. Straight back at you from Spain. I believe they bought Fear Kaiser, possibly. I don't know, but it is bizarrely cheap. So maybe it's worth going down that rabbit hole. High rates of return, cyclical business, yes. Probably a lot of debt, bizarrely cheap. Repurchasing debt, buying back stock. Could be very interesting. Could be super interesting. Okay, guys, I think we have run out of questions. So I'm gonna leave it there. And I hope you guys enjoyed today's stream. I just wanted to introduce you guys to a little bit of the micro to marry up with the macro from last month. And maybe we'll do something a little bit different next month, where we might have a discussion on sort of, idea generation and stuff like that. And maybe I'll invite Hugo on as well, because he's looking pretty closely at Solar Edge and the solar market, cybersecurity as well. And he done very well with housing, etc., and some of the distributors, etc. So he's gotten some really good trends really right. It'll be interesting to hear his view. Okay, guys, gonna leave it there. Really appreciate your time today, and I will catch up with you guys next month. So have a great day, everyone, and I'll catch up with you guys soon. All the very best.